I will take a look now. I'm actually on Real Stream. It looks like it is. It's got you're online on your Facebook page, but remember, I don't know if you have to click go live. So
I'm going to look on my Facebook page now.
And then when you go in the, actually, I can do that for the Jewish report. You don't need to do that. I will go to the Jewish report, and if you're happy for me to click go live, because it's almost 7:30 actually.
Okay. Have you? Did you change the names and numbers of the name of the webinar?
I'm going live with the actual webinar event, not the. Oh, you're talking about on Real Stream.
Yeah.
Let me just do this. Where to stash your cash?
Okay, so it's live on my personal page.
Great, and I'm gonna make
let me check. Let me check. It's live on YouTube.
Cool. And next, done. Go live. Cool. And I'm clicking go live on Facebook, Jewish Report Facebook now.
Yeah, we're live on YouTube as well.
Great, and we are live on Jewish Report Facebook as well.
Fantastic. So Danny, you're going to put up the holding slide. Dino, we'll see you 7:45.
If Dino's still with us. Okay. Cool. Howard, we're ready to go.
Fantastic. I'll see you 7:45.
Fantastic as well. Fantastic.
Dino, this is new frontiers. This is new frontiers.
Breaking new territory. I love it.
Cool.
Love it. Okay.
See you in 20 minutes.
Great stuff. And I'll send it out now. Share screen.
Stay with me if you want it. Stay with me if you want it. Stay with me if you want it. Stay with me if you want it.
Good evening, everyone. The time has just gone 7:45. We're going to be starting at 8 o'clock. A good evening to all of you watching already. So nice to see such amazing interest in tonight's panel. We've had thousands of people registering for tonight. So apparently people have cash and they're desperately looking for somewhere to stash it. So I presume my advice is going to be under the mattress where people normally stash their cash, or in Swiss bank vaults, although I've never quite understood that. So we have an incredible panel of diverse views ahead of us. Dina Diamond is going to be hosting tonight's panel, and I see some of our panelists are connecting already. How's it? How are you doing?
I'm good, thanks. How are you?
Good to meet you. I'm Howard.
Hi, Howard. Sisa. Lovely to
Hi,
meet you.
Sisa. I was going to ask you what people call you for short.
Sisa, please.
Nice to meet you, Sisa, and Professor Piet.
Likewise.
Have you started the academic year yet?
Yes, we have. Yeah.
But lectures aren't going to get going for quite a while, hey?
Yeah, face-to-face lectures. Yeah, so the lecturing at the moment is by way of webinar, Zoom. So similar platforms. Yeah.
Okay, so no lecturing tonight, just honest, truthful discussions about what we should be doing and where we should be putting all our money.
No, I'm going to lecture to you guys.
No one's going to listen, like your other students. They turn off their camera and they're either asleep or naked. Those are the only two things.
Yeah, it's true.
Cesar, tell me, at your work, we're in a meeting. Do you allow people to have their cameras off?
Yes, I think I actually prefer it that way. I don't want to see things I shouldn't.
Dina,
I was helping a panelist try get on. Technology doesn't always necessarily work the way one chooses.
Dina, have you been on any webinars and seen things that you shouldn't have seen?
Nothing that untoward. I have seen lots of videos that people post on social media, which is a bit scary. People lying in their bed, underwear, what have you not.
At least they're wearing underwear. You have to be grateful.
Yes.
This is true.
And Jaco van Tonder, welcome. Nice to have you with us.
Yes, good evening, everybody. Yeah, there's been some funny events. I've defaulted to making damn sure all my video recording equipment have got that little slider that cuts off the camera manually. So you don't have to ever set it at software level. You make damn sure that thing doesn't actually display anything.
So have you noticed that Mark Zuckerberg actually uses one of those himself on his own computer?
Yeah, exactly. No, that's the only way to be sure, because I think they understand that webcams can be hacked. So mine only ever goes open. Mine only ever goes open when I want to use the camera. I switch it on, and then I switch it on the computer, and then when I'm done, I switch it off again.
I've actually contemplated buying one, and you've just sold me.
We always presumed it was Mark Zuckerberg who was watching us at those moments. We didn't realize that he himself was worried about the exact same things. So
but that's why we should worry, Howard. That's exactly why we should worry, because if he's doing it, we know there's a problem.
So before we welcome Jarrod, who's I see joined us from London, and Kyle, who's joining us, I presume, from Cape Town. Piet, let me just ask you, I see you logged in twice to this webinar, once with the camera and once not. The other person that says Professor Piet, can we boot them off?
Yeah, you can. I actually tried to do that now, so it's still showing, because I noticed that I had it twice.
Yeah, it's still showing. So let's see if I can remove the. I've removed that participant. So if it's your spouse, please forgive me.
Yeah, no, it's a friend that I wanted to join for free.
Well, we don't charge anything, so that's the easiest thing in the world. Jarrod Cahn, you're not wearing a sweater, you're not wearing a jersey. There's darts behind you. Are you joining us from a summery London pub?
Very much so. I'm actually in the loft. I'm actually trying to get my background off here, so I don't know where that function is, but I'm trying to actually change the background.
I have only one word of advice for you, and that is, if the dartboard is behind you, make sure you go insert all the darts in the bullseye, so people at least presume that they were naturally put in there.
I will do. All right, Howie, I'll do that.
Nice to see you, Jarrod. Welcome
Thank
back.
you.
Nice to have you back on the webinar. Kyle,
Thank you.
do you join us from Cape Town? And it looks like you've got a Bitcoin behind you.
I wish I had at least one Bitcoin.
I believe we sent you some Johannesburg weather down your way in Cape Town today.
Not yet. I'm hoping for some rain, but nothing yet.
Oh, has it now? I spoke to someone earlier. They told me it was raining their side.
Yeah,
No, lucky them.
Yeah, it was overnight mostly.
Howard, it depends who you're speaking to. Maybe it's questionable.
Yeah.
And anyone who speaks to me has to be questionable, Dina. That's how it goes. So while we're waiting for everyone to join, please let us know where in the world you're joining us from. We'd love to actually know and be able to say hello to you all. We're trying something new tonight. We're not only broadcasting on Zoom and YouTube, which are our two traditional channels, but we're actually broadcasting for the first time ever tonight on Facebook as well, on 2 channels on Facebook. And that will make our reach even larger. It's quite amazing because a standard webinar for us is probably 4,000-6,000 people watching. Some of our bigger ones have gone up to 60,000 people watching. So let us make sure that you are all entertaining and enthralling tonight, that we get back up to those numbers. So I see Joe is saying hi from Jerusalem. Did you see the pictures of the snow in Jerusalem today? Looked unbelievable.
It's a crazy thing because it's actually quite a phenomenon for it to be raining and snowing in Jerusalem, but even the snow everywhere. So the snow in New York, the snow in London, I think this year it has been insane. Nothing like a bit of global warming and climate change.
So Robin is joining us from Cape Town, and Sol says that we're not in focus, but seeing we don't control the focus, I can only presume that Sol needs to put on his glasses. Sol, that's the only recommendation that we can do, I'm afraid. So,
yeah, and again, the president has allowed alcohol, so you never know.
Kyle, I have a question from you because Dina desperately wanted someone to talk about Bitcoin on this panel. And I said, I don't think it's fair to the people watching us to have just someone promoting Bitcoin when there isn't someone talking about the other side. So we mentioned it earlier. Kyle, do you hold any Bitcoin?
No, unfortunately not.
But
not even one.
Do you recommend it as an investment to anyone?
I certainly don't understand it.
Okay, you are of the appropriate age to understand it. Piet, I'm not suggesting that you're older than Kyle. Maybe you just more unshaved than him. So Piet, what's your view on Bitcoin?
Let's stick to, I also don't understand it. I've seen it from speculative from the start. If you enter into that, it's a speculative. I don't know why the value fluctuates as it does. So I don't have any. I've not had anybody want to pay me in it either. So yeah, I wouldn't recommend it as an investment.
Before we ask Jarrod that question, because maybe Jarrod has a different view, I want to be slightly less diplomatic than both Kyle and Piet. And I want to say, I think this is the biggest Ponzi scheme we will see of our lifetime. Jarrod, what do you think?
I agree with you. Howie, to be honest with you, I think it's actually quite an interesting alternative to gold. So anyone who is of the gold mindset, the conspiracy theorists and all that, and they think that the government's all going to collapse and that the dollar has no value, this is a great alternative to gold. But yeah, listen, who knows? Having said that, there are some very, very clever investors right now that have put huge amounts of cash behind it. The likes of Tesla and Rafa. The names are huge, and they're making a lot of money out of it. Now, whether they're just trading it or whether they really believe behind it, that's a different story. It's interesting. Let me put it. I'm not buying it for my clients. I think there are a lot of issues with it, but there are certainly a lot of people out there that love it. They are, they've drunk the Kool-Aid, and they're very happy to buy it, and they're making lots of money out of it. So good luck to them.
So I'm so happy to hear that. I'm very relieved to hear that, because I have been mulling over Bitcoin for so long and have been harassed and hounded by people saying, you've got to buy now, look at what Tesla's done, blockchain is the future. And I'm in the same boat. I just don't understand it. Just don't get it. It's like piracy currency.
Daniel, I want to remind people that we're going live in about 5 minutes time. But before we ask Sisa about her view on Bitcoin, Jarrod, you mentioned Tesla. At these prices, is Tesla another Ponzi scheme?
It's not a Ponzi scheme. I just think, again, people have drunk the Kool-Aid. They believe in the EV market, and it's clearly the electronic vehicles is the next, the next big thing. But it's very hard to justify these valuations in terms of, their market cap, what percentage of the market they actually need to control. And the fact that, in fact, they've actually just cut their prices on one of their vehicle models today. So I just think people are
that the
getting
Bitcoin
a little bit
price
ahead
or
of
the dollar
themselves. Yeah, and listen, it's not only Tesla. There's Neo, there's Nikola, there's a whole lot of them. Li Auto. It's just it's part of this Robin Hood brigade that have just flown into this market. They're loving the EV stocks, and you want to be there for the future. The problem is how much you're willing to pay, and people are prepared to pay up for future earnings. And personally, I think it is way overvalued. But having said that, at $300, I would have said the same thing, and it's now significantly higher. So I would have lost my pants.
So Jaco, do you hold Tesla or Bitcoin in your personal portfolio?
I held a bit of Tesla, but not Bitcoin. And I'm afraid to say I sold out of Tesla because I'm one of those who thought that the steam was going to run out quickly. And obviously I'm very upset with myself and have been ever since selling out of it. So I got some money out of it, but nowhere near as much as I could have made. But Bitcoin, I have to say, I'm with the rest. It's a speculative investment. I've never actually signed up for a wallet. I came close a couple of times just to see what it's like. But I have to concur with some of the opinions here. I don't understand the scarcity value and how that is going to be controlled. And anything where you cannot control supply in a supply and demand world, I become worried about it. If in some way supply can be created by means that maybe we haven't thought of today, it means the value of that commodity will collapse. And that makes me a little bit concerned. I understand what's required to get gold out of the ground. I don't quite understand what stops someone from inventing some supercomputer and creating a lot of Bitcoin through mining tomorrow. And that's what kind of has me worried. So I think it's a great speculative investment. It leads to great stories around the campfire, but I'm not going to put my retirement assets in those.
Well, in order to create a Bitcoin, one of the key inputs is electricity, because you need a lot of the electricity to churn through processing power. And therefore, people in countries with cheap electricity tend to win. So Iceland, a fantastic place to create Bitcoin. Parts of Siberia, cheap electricity, great option to create Bitcoin. Those of us who faced with 15% increases in Eskom prices are probably a terrible place to mine Bitcoin. But then again, the South African mining industry hasn't been healthy for a while. Kyle, what is your view on mining stocks?
At least those are easier to understand than Bitcoin. I mean, you mine both, and there's a cost to getting out the ground, but somehow the cost of mining Bitcoin is not related to the price at all. At least with the miners, we have some sort of fundamental valuation to that.
And it is a little difficult to explain how you go up from $8,000 to $50,000 in a single year without anything fundamentally changing.
51, yeah.
51. And just before we go live, we've had the story of Robinhood over the last few days and GameStop. Let's just ask each of the panelists, on whose side are you? Are you on the side of the hedge funds, or are you on the side of those trying to upend them, the little guy, for want of a better description? Some of whom may not be so little after all. Piet, whose side do you fall?
I haven't taken a stance yet. So yeah, I think there's merit in what the small guys are doing. But no, I've got no view really at the moment. So,
Jaco?
I don't think I can pick between the two, because I think they're both wrong. Short sellers have been wrong for a long time. they're actually market manipulators. You know, they just do it in different ways. So the fact that two market manipulators meet each other halfway and hand each other a couple of bloody noses is not a bad thing. It's nice to sometimes see this, you know, the people who harm other individuals get back at each other. But I mean, at its core, both of them are committing market manipulation by changing a price way away from what its true value is in the hope of making a profit. And so I don't think I can condone the behavior of either sides, but it is quite interesting to watch the whole fight play out from a distance.
Carl, have you selected sides?
Yeah, I'm also watching with bated breath. I mean, it was fascinating to see Elon Musk buy some Bitcoin and then to see what happened to the Bitcoin price after he bought one tweet and he made himself a fortune. It's amazing how social media can influence these very illiquid positions.
Jarrod, you have to take a stand. I don't believe you've been on the fence on anything.
Yeah, so I'm actually I'm mostly on the side of the David in this fight. In other words, the small investor. But what I didn't like was the fact that not so much the regulators, but the brokers got involved, and they stopped allowing the purchase of GameStop at a very important time for many investors, which effectively closed people out of the market from closing positions or being more speculative. And I thought that was actually very unfair. But if I had to pick, you know, the hedge funds for years have been able to bully the market, and they use margin. This is their game. You know, they're club, they communicate with each other. So they're getting a little bit of their own medicine here. And I think what happened was, you know, as I say, it's not quite the regulators, but certainly the SEC and certain market participants did step in. In a way, they protected the hedge funds, which I thought was very unfair. And it was unfair to the little guys who genuinely, maybe some of them did want to close out of positions from being long. And I thought that was unfair. And listen, I mean, we can discuss it another stage, but I think the real issue here is not the vanilla short sellers. It was all the option traders around this, and the fact that they allowed so many options to be opened up against, or contracts to be opened up. And you had actually the banks who had to go into the market to cover these options, which effectively created this vacuum, this short squeeze. So it's fascinating. It's going to be a great story to study at all these fancy universities in America. But I'm quite happy, not happy, but I think it's great. It's great for the little guy to win every now and again.
Sisa, turn on your camera. We'd love to get your view on the matter. I hope Sisa's behind her name on the camera. Ah, there you are.
I'm
Sisa,
right here. And I think for me, it's like a game of politics. I prefer to be apolitical, but if I do have to pick a side, I would definitely go with David as well. I'm always on the side of the underdog, but that's just because I'm a short person. I'm generally on the side of the underdog and also trying to do things differently. I'm very much about challenging the status quo and challenging how things have always been done. So I kind of look at little guys and I'm like, okay, that's brave, especially if you've got like something to hold on to. So if I were to pick a side, it would be the little guys.
Okay, cool. So I'm going to go ask everyone to turn off your cameras if you don't mind. We're just going to do an introduction. The time has just gone 8 o'clock. A huge welcome to everyone. Danny, what number webinar are we on tonight? Danny's turned off his camera.
This is, I think, number 7. Is it 77, Howard?
76.
76. The 76.
76.
Wow.
And Dina, you've assembled a remarkable panel tonight. Tell us who's on the panel this evening.
Absolutely. So, I mean, again, so we saw from our last investment webinar that there was like so much interest in what is actually going on in the financial markets. And we thought, where to stash your cash is quite a good idea. How do we find it out? So we went to the industry experts. We have got Kyle Hulett, who is the head of investments at Signia. We've got Jarrod Cahn, who is from Credo Group in the UK. We've got Sisandile Cikido, who is the head of retail investments at Nedbank. We've got Jaco van Tonder from 91. And then we also have with us a seasoned professor, Professor Piet, who's a tax specialist and visiting professor at Wits. So we have got the true specialists in the room to find out, our virtual room that is, to find out where do we stash the cash. Is it in the mattress? Is it in the fridge? Or
is it in the ice in the fridge?
Exactly.
Where we stick our diamonds? Is it in a vault in Switzerland? So
exactly. So many options, but it's apparently not in Bitcoin.
Apparently not amongst the people on the panel, but we're certainly going to be addressing this issue of Bitcoin over the next few weeks, because I think it's just such a fascinating topic. And there's so many people with such polarized views when it comes to Bitcoin that maybe it's younger versus older generation when it comes to investing. And maybe those of us with less hair or gray hair actually just don't understand that. But that's certainly a webinar that we'll have in the next few weeks. But very importantly, the latest edition of the Jewish Report is out. Danny, you're on controls tonight. Show us what the front page looks like. So a huge spat with Reverend Frank Chakani in the center of an anti-Israel storm. But really what's absolutely inspirational, we got pictures from yesterday of some of the first doctors receiving their COVID vaccine, their Johnson & Johnson vaccine shot. So that's such an exciting, uplifting story. You have to get your copy of the Jewish Report, and you can do that by going to Pick n Pay or Spar, Checkers, Exclusive Books, CNA, your local garage shop, your supermarket, your kosher restaurants, your kosher butchery. Any of those would have your Jewish Report, or you can go online to www.sajr.co.za, and you can either download the full edition or you can look at each individual story one by one. So let's just repeat that address, www.sajr.co.za. And I want to tell you a little about some of the webinars that we have coming up over the next few days. So we have a remarkable webinar on Saturday evening, and it's called Saturday Night Unplugged. We've gone to some of the best performing artists around the world. We have Americans, we have people in India, we've got people in Israel, people in South Africa, people like Cindy Alter. You may remember the name, very famous singer, Cindy Alter. And we've said to them, we want to do all of those bar classics, the Rodriguez's, the Jim Croce, the Counting Crows, the Piano Mans. We want to do all of those on a Saturday night, but not as a big concert. We want you to go get a glass of whiskey or wine. We want you to put on your slippers and put your feet up onto the couch and just have almost a sing-along evening with us as we go through some of those remarkable classics. So 8:30 on Saturday evening is Saturday Night Unplugged. Danny's going to post both on YouTube and in Zoom the link so you can go register. It's going to be the most spectacular evening. You don't want to miss that. And then on Sunday, a very exciting thing actually happens tonight. IEB matric results come out at midnight tonight, apparently. And there will be drunken matrics all over the place, we're sure. And we're trying to sober a few of them up for Sunday, because on Sunday evening at 7 o'clock, we're going to delve inside the mind of the matric class of 2020. We don't want to hear how well they've done in matric. You know, that's for them and their friends and their family. But we want to understand their view of the world. We want to know, do they believe in God? Are they worried about climate change? What do they think about drugs? What's their sense about virginity? When is the right time to have sex? What are the big issues in their life? What are they going to do next year? What don't their parents understand about them? We're going to be addressing an entire range of issues. What are the brands they love and identify with that have their values? What are the brands that they hate because they think they don't represent them? So on Sunday evening at 7 o'clock, we're going to delve into the minds of the matric class 2020. And the last webinar I'm going to tell you about, because Dina, I know you want to get going with your panel, but the last webinar I'm going to tell you about is next Saturday night, because Dina, Thursday night, you know what Thursday night is? Thursday night is Purim, where we read the Megillah, the book of Esther. We tell the story of how the Jews of Persia, the Jews of Shushan, were about to be murdered and were saved by the queen of Persia with the help of God. And we read the book of Esther. And one of the great traditions of Purim, well, one great tradition is the fact that we should get so drunk that we shouldn't be able to tell the difference between the good guys and the bad guys in the story. And another tradition is a tradition of parody and comedy. Newspapers write what they call Purim spiels, these ridiculous over-the-top productions that no one can believe, the equivalent of April Fool's Day. But there's another thing called a Purim spiel, a Purim play, which is a great tradition, a great Jewish tradition where we read the book of Esther. We have gone to some of the top performers in the country, and we've asked them to put on a Purim play for us. Next Saturday night at 8 o'clock, we are doing the Purim play, and it's called Purimton. It may resemble a Netflix show that Dina obsesses about. Dina, what's your favorite show on Netflix?
At the moment, Bridgerton, actually.
Bridgerton comes to Purim in Purimton next Saturday night at 8 o'clock. So you got 3 webinars to really watch out for. Obviously tonight, tomorrow on Saturday night Unplugged, Sunday night delving into the matric mind, and next Saturday, Purimton, our Purim play. It's an amazing week that we have planned for all of you tonight. So once again, just before I hand over to Dina, I'll be monitoring the Q&A section. So if you have a question for any of our panelists, please, at the bottom of your screen, if you're on Zoom, you'll see Q&A. Please post your questions into the Q&A section. If you're on Zoom, please put your questions in the chat section. I'll go grab them off and I'll bring them across and bring them to Dina and the panel to answer. But please, as we go along, chat in the chat section that you have. A huge welcome to all of you to webinar number 76 of Lockdown. And Dina, with that, I hand over to you, and all your panelists can turn on their cameras as we thank Danny for everything that you did tonight. You're on controls tonight. Dina, have a good show.
Thank you so much, Howie. And yes, we have got a very capable person managing our Q&A tonight. So guys, I know we've got so many experts on our panel tonight. I think that we are actually going to have an absolutely like fantastic panel. I think there's so much information that we can get from everyone. And so we thank all of you, Kyle, Sisandile, Jarrod, Professor, Jaco. It's absolutely wonderful to have you all, and we appreciate all the time that you're going to give us. We have already had over almost 1,000 registrations before we even went live tonight. So we know that there's a fortune of interest in this topic. And so what we are going to do, so we've got all our panelists on at the moment, but we're going to start with one by one, and then at the end we're going to come back and we're going to have a Q&A, and we're going to address questions that maybe some people got in or got ideas of during the panel. And yeah, so thank you so much. So the panelists can all actually switch off the cameras. We're going to start with Kyle, and we will see you all shortly. Thank you. So Kyle, good evening. Lovely to have you with us in your blue background. So your Signia.
Good evening, Dina.
Good evening.
Thank you very much for having me tonight.
Absolutely lovely to have you. So yeah, sorry, Howie couldn't resist that question on the Bitcoin, because I mean, when I saw it going to 51,000, I was like, and I was in, and then I was like out. I'm going, I don't understand it. So I was like, okay, I have to be out because I don't understand it. And then it went to 51,000, and that's when you get upset.
Definitely.
Anyways, but I'm sure that's going to be the.
So this is the Signia coin. It's about low fees. Unfortunately, it's not a Bitcoin. I really wish it was, but it's all about saving money and saving fees.
Fantastic, and it fits perfectly with our theme tonight, where to stash your cash. So I know you've prepared a presentation for us, and you're going to give us a bit more of a global outlook and view of the world. So please do share with us.
Great, thank you. So it may seem a bit strange that I'm talking about where to stash your cash in a low return environment. We've got stock markets reaching new highs. We've got Bitcoin at 52,000. We've got Tesla. We've got basically commodities at decade highs. The stock market's up 30% over the last 3 months. Everyone's euphoric. Everyone's bullish. Everyone's very excited. So talking about a low return environment does sound rather strange. And we certainly are bullish at the moment, and we have been positioned for the cyclical bounce, but we believe that the multi-decade roadmap that we use, which we call japanification, remains appropriate for the long-term investment planning. And I'm going to take you through that and explain exactly why that's still relevant, and then go on to a more short-term outlook, and then talk about how we're positioning our portfolios and where we think you should stash your cash. So why lower real returns and what we call japanification? Well, there's 4 points to this story. The first is higher starting valuations. And really, it's about not having a free lunch anymore. So from the late 80s to the early 2000s, we had 30 years, it was just a great party. We had interest rates which went from sky high down to zero now, and in some countries, interest rates are zero. And interest rates are the cost of money. So as that cost of money came down, so every asset class reflated, whether it was gold or bonds or equities or your house. As the cost of money came down, so everything went up. But now we're at a point where the cost of money is zero. And we're seeing all sorts of strange things happen in the market. And it's one of the reasons why Bitcoin is so high, why gold has rallied, and why there are just really some crazy valuations out there. So our starting point now is very different to the starting point as it was 30 years ago. The second, and probably more importantly, is high debt. So the world has been through 3 major crises over the last decade. The Great Financial Crisis in 2008, we had Brexit 2011, with the Chinese currency and shadow crisis 2015, and most recently the COVID crisis. And in each single one of those crises, we managed to crawl our way out by taking on more debt. And global debt to GDP is now at an all-time high. And all we've done is we've stolen from the future and we've used to plug a hole. But at some point, you need to address that debt. And the problem is that in the past, the last time debt was this high was 60 years ago, and we were able to grow out of that debt. But now we're facing much lower growth. And that's for 2 reasons. The first is aging demographics. And Japan started the story in the late 90s when their population started to age quite rapidly. And GDP is made up of 2 parts. It's the number of people that are working and how productive they are working. So when you get to a point when your population starts to age and you have fewer people who are working and more people dependent on retirement benefits, well, all of a sudden you have a smaller workforce and you actually need higher taxes to look after those who have retired. So we're seeing that shift across. Firstly, in Japan, it's shifted to Europe about 10 years ago. China is nearly at that inflection point, and the US is about 5 years behind. But we're reaching a point where populations, that the working populations are starting to shrink, which then puts all the emphasis on productivity. And productivity gains are also not coming to the party. We had huge productivity gains in the 70s and 80s with the advent of the computer, but more recently, the fourth industrial revolution, which is all about social media, it hasn't seen the same impact on productivity numbers. And certainly the marginal increase in productivity is falling. So we're seeing much lower growth, which is not allowing us to grow out of debt. We're constrained by this debt, which forces us to pay a lot to just service the debt. And you're trapped in this vicious cycle of expensive assets and a very difficult path to get out of it. And that's why we look at Japan, because fortunately, this has been done before. Japan was here 30 years ago. They moved into a low growth, high volatility environment 3 decades ago, driven by a balance sheet recession, aging populations, and skyrocketing debt. And by 1997, they started quantitative easing. So they were the first party. QE is something that they've been doing for 23 years now. So let's look at the success of Japan. Well, at the moment, the Central Bank of Japan owns more than 100%, or their balance sheet is more than 100% of GDP. The Bank of Japan owns nearly 50% of all government bonds. And Japan's debt to GDP is the highest in the world, or developed world at least, at 230%. So they have done everything they could think of to protect jobs and to make sure that the economy doesn't spiral into depression. And it's worked to some extent. They have protected jobs and they haven't gone into a massive depression. But the chart here just shows the lack of success on the other hand. I mean, we've got no inflation for 20 years. Bond yields falling. GDP at 0% for 20 years. The stock market, you can see that moderately up over a 20-year period, but with huge volatility. And yes, there have been periods when the stock market has doubled, but then it's halved. And we think that's what we're seeing now. We're currently in a cyclical bounce, and yes, you need to enjoy it and take advantage. But we think that the most likely roadmap is for the next decade or 2 decades is Japan. And certainly not as bad, because there are parts of the world like emerging markets that don't face the same demographic challenge. And the US, as I said, is a few years behind. But that we need to think that will realize the backdrop that we're fighting is so severe that we've had to have the largest fiscal stimulus in 2 decades just to get stock markets up from 3-year lows. So what do you do in this environment? Well, we all have the traditional asset classes. We understand equities, we understand bonds, we understand cash. Bond returns and cash returns are certainly a little bit lower than they were in the past, but not substantially. The big change is equities. Equities are linked to growth, and with low growth, equities really struggle. And you end up with going from the dark blue line at the top with a high equity return to the lighter blue line here at the bottom with a lower equity return. But the problem is the volatility stays as high or potentially even higher because of the huge amounts of debt. And that means that there's going to be far more frequent times, you can see this orange circle, where your portfolio, your investments, your assets, your wealth dips into a negative position. And that's incredibly uncomfortable for anybody. And certainly is a big risk if you're nearing retirement. So how do we deal with this new regime of low returns, low growth, high debt, and high volatility? So fortunately, there are 4 things that can help. I suppose when it comes down to the real difficult question is you probably need to work harder and save more. But within the framework, there are 4 things that can help. The first is looking at your life staging process as you near retirement. If you were going from a high risk portfolio to a low risk portfolio, say 3 years before retirement, you need to make that 5 years. If it was 5 years, you need to make it 7 or 8 years. You need to have a much longer smoothing period when you rotate out of high risk into low risk to allow for this additional volatility that we are experiencing and the lower returns that are unfortunately with us. The second thing is that fees are critical. It's fine when you're earning Bitcoin-like returns, you really don't mind what fees you're paying. But if you're earning 7-8% a year, 2% makes a huge difference. And in fact, just taking 2% off your fees every year will result over 40 years in nearly a 50% increase in your retirement investment. So fees make a big difference. And that's why we are confident that the passive debate is over. Not only is performance being better, but let's ignore performance. Let's assume performance is the same. The fact is, whether you want all passive or only some passive, to get the cost down of your investments, you have to have a portion of it in your fund, just to save some fees, just so you can afford to have a more realistic return in the low return environment. The third step is something that we firmly believe in and have been doing at Signia for over 13 years, and that's managing risk using tactical asset allocation. Basically, what it means is that there's a lot more volatility now. So in the roaring 30 years we had from the early 80s to the late 2000s, it really didn't matter what you held. You could have been only in bonds, even cash gave you inflation +2, or only equities, or only any asset class really was nearly enough to retire. Now, when you've got a lot of volatility, not only is there more opportunity to rotate between different instruments from an asset allocation perspective, but it's more necessary to harness that volatility. So we do that from a top-down risk management framework, and it's all about reducing risk relative to the return you're expecting. And lastly, it's about looking for diversified sources of return. So in a world that has low growth, which is what we're facing now, certain industries are going to struggle. Your traditional industries that have always looked after you are going to be competing for market share in an environment where there's no growth, and they'll probably end up competing on price. And it's going to squeeze margins. You need to be looking at niche areas where market share is still growing. And that tends to be in the technology-based sectors or the innovation-based sectors, where you're seeing new concepts, new ideas, new technologies growing market share, regardless of what's happening to the overall world and the overall spend. So and there's certainly a lot more of that globally than there is in South Africa, unfortunately. So we like being global. We like looking at these alternative diversified growth sources. We have the Fourth Industrial Revolution Fund, which is up 90% over the last year. We also like credit. It's good to diversify on the local basis. It's good to diversify from equities, to not have all your eggs in this volatile basket. And then other alternative assets like venture capital. And that's another product that we do. And unfortunately, a lot of the great concepts and new companies out there aren't even allowed to list. You've got early stage venture capital, which then sells to mid stage venture capital, which then sells to late stage venture capital. And if you just invest in the stock market, you don't even get a chance to get involved in some of these super exciting activities. And again, globally, locally, there's not as much opportunity, but globally, we're focusing quite a lot on that as an alternative source. Which creates a barbell approach. We talk about passive on the one side, alternative growth on the other side, and then traditional long only in the middle. So those are our 4 keys to success in a low return environment. But let's look at just where we are at the moment in terms of our short-term outlook. We've been quite bullish for the last 3 months, and it's worked very well for our portfolios. And there's certainly a lot to be bullish about in the short term. It's hard to disagree. We've seen the largest vaccine rollout in history. More than 176 million doses across 78 countries already have been administered. Well, let's not talk about South Africa. That's as usual, not as effective and implemented project as possible. But around the world, things are looking amazing. Israel in particular, leading the world, 72 doses per 100 people. It's just phenomenal. And certainly markets are looking at this vaccine rollout, and they're looking through the risks of new variants, and they're saying that the new normal, maybe not the old normal, but the new normal is on its way. The second thing that we're very excited about is the largest fiscal stimulus in history. The Democrats' control of the White House and both houses of Congress for the first time in a decade has allowed Biden to put forward his American Rescue Plan, $1.9 trillion. Certainly, if it gets it passed, will be the biggest stimulus plan in history. When you look at the chart on the right, the fiscal stimulus on the left-hand bars and the lighter gray compared to the great financial crisis of 2008, it's just dwarfing it. I mean, the amount of money that's being pumped in, literally helicopter money thrown at American citizens, $1,400 cash each. It's hard to get bearish when there's that much cash in the system at the moment. And we don't have to worry about the Fed. I mean, normally, the Fed would be quite concerned about this huge amount of stimulus, but the Fed said, don't worry, we're going to hold, we're not going to wind down QE. We're going to keep buying $120 billion of bonds a month until we see substantial economic progress. And we're going to hold interest rates near zero for much longer, at least until 2023. So the Fed's not taking away from the party. We've got huge amounts of stimulus. It's very hard to be bearish in the short term. You look to the east. Emerging markets in China doing incredibly well. China's economy is expected to have grown 2.3% last year. In a year when we had the steepest and the fastest and deepest recession in 60 years, it's incredible that they can still grow 2.3%. And this huge fiscal stimulus that we've seen is driving commodity prices to new highs. And not only that, but having the Biden administration and the Democrats, they're much more focused on a more collaborative US foreign policy. It's just perfect timing for EM and China. No longer worried about trade wars. Those risks have receded. Huge amounts of fiscal support driving commodities and demand for Chinese products, and growth looking very strong there. So 3 very strong global pillars that it's hard to be bearish. Then we look at South Africa. And unfortunately, even when everything is going perfectly around the rest of the world, somehow South Africa is at best a mixed bag. We are, and it was very important, we had to keep reminding ourselves of this last year when things were looking utterly bleak, that we are a small open economy. We are very much dependent on China and commodity prices. And that's why when the Rand was at 19, we were very, very bullish on the Rand. There was no way it could keep weakening. And it has. You can see here this chart, the white line showing the Rand strengthening massively on the back of strong commodity prices. Not as much as we should have if everything else is equal, but doing incredibly well. We're being dragged up kicking and screaming by global growth and global commodity prices. But we still have a lot to do locally. We've got February budget coming out on the 24th of February. We'll be watching it to see exactly what Tito does. Eskom is key. It's unlikely he's going to fix Eskom in the budget, but until we see Eskom being fixed, there's no way we can have strong growth within South Africa. We need to see what's going to happen around that. And the vaccine rollout plan, even though we knew it was essential, a lot of confusion still exists. But there is a silver lining. Because of this huge amount of uncertainty, South African bond yields are amongst the highest in the world. You can really, you can be in Japan, you can earn 0% in your 10-year bonds. Europe, negative yields. The US now, it's just gone over 1%, but still close to 1%. Or even in dollar terms, on a hedged basis, you can earn 6% in South African bonds. So that at least is some way to hide for our local investments. So what does that mean? What about, if you bring it all together in terms of where to stash your cash in a low return environment? Well, markets have certainly run very hard, up 30% in 3 months. But markets, as Warren Buffett likes to say, are manic depressive. They very, very seldom sit at fair value. They go from cheap to expensive and back down to cheap. And the chart here on the right shows the huge amounts of cash that are still sitting on the sidelines that are going to drive this market way into the expensive territory. So in the short term, we do think that this market has legs. Longer term, we're very worried about debt. Hopefully that's a 2022 problem. If we're lucky, maybe a little bit later, but certainly our japanification roadmap for a decade-long outlook remains in place. We do have our deadlines, the 28th February deadlines for the tax-free savings accounts and retirement annuities. So if you do have some cash you want to stash, make sure you've maxed out your tax-free savings account. 36,000 Rand per year, tax-free. You don't get free lunches like that anywhere. And that can be 100% global. It doesn't have to be only local. There are no restrictions. So make sure you open up a tax-free savings account and take advantage for yourself or your children. You can open accounts in their names. Take advantage of that. Retirement annuities also have your deadline by the 28th of February. If you haven't invested your full 350,000 Rand, you are up to 27.5% of your income. Make sure you're using that. Otherwise, when it comes down to products or funds, if you're looking for yield and you want something that's a little bit low risk, Signia offers 2 zero management fee funds. We're the first to the market in this, first in South Africa, 2 unit trusts at absolutely zero fee. No fee, no smoke, no mirrors. It really is a zero management fee product. You can invest in our money market fund, which is earning 4.2%, and that's daily liquidity. So if you have money in the bank, you can earn a lot more in a money market fund, well diversified, daily liquidity, 4.2%, no fees. Or if you are prepared to take on a bit of a longer term time horizon, you can have a little bit more volatility associated with bonds. We have our all bond fund, which tracks the bond index. Again, yield there is about 9.2%. That's a really decent yield amongst some of the highest in the world on a hedge basis. No fees and available to all retail investors. So please take advantage of that if you're looking for a bond-like investment. And then with the Rand at 14.50, it's looking pretty fairly priced, if not starting to move towards the expensive side. Then it's a good time to take money offshore. And then you want to look for global growth that's niche and focused. We have 2 thematic funds, the Signia Fourth Industrial Revolution Fund and the Signia Health Innovation Fund, both exposed to themes that we think have strong tailwinds. I've spoken about the Fourth Industrial Revolution Fund in terms of new ideas and innovation and tech, but on the health innovation side, we've got huge, probably the biggest amount of money being pumped into healthcare right now to chase for vaccines. And there's more than likely going to be a lot of discoveries that happen by accident. I mean, we all know Viagra, birth control, so many fantastic drugs that are found by accidents. But even if you're not that optimistic, we've got aging populations, we've got rising LSMs. That means people have more money to spend for longer post-retirement. They are going to be spending in that sector. So we think these are 2 sectors that, even in a world that's struggling to find growth, we think tech innovation, healthcare innovation are places that can still gain market share even when other industries are struggling. Okay, I can breathe now. That's that. I hope I finished in my 15 minutes.
You did very well. Thank you so much. So yeah, I think that you've definitely given us like a lot of food for thought. You've given us a lot of information on the markets. You've given us a lot of information on literally where to stash your cash. So I actually wanted to know, so if you, obviously there are different stages of your life and there's different times when you have to invest different amounts of money. We've got some questions that are coming in, and maybe Howard also can come in here to answer, because I know I can see there are questions coming in from people to say, like, so if I've got basic amounts of money, I've got, like, I'm starting out in life, where should I be putting my money? Would you recommend? And we're going to talk a lot more about those tax-free investments. We're going to talk about RAs. We've got a whole bunch of experts on our panel with that. What would you say? Because obviously there's also life stages. I know Signia looks at your life stages and looks at those investment classes and what you should be doing. So if you're starting out, where should you be stashing that cash?
The most important question you have to ask yourself is your time horizon. It's far more important than understanding your risk. Is when do you need the money by? Is it tomorrow? Is it 5 years? Is it 30 years? And if it's longer than 5 years, you can start to look at portfolios that involve more growth focus, equities, global, and those higher risk, higher return assets. But if your time horizon is shorter than that, then you need to balance a portfolio with some cash and some bonds and some more stable investments. So it really depends on, you need to understand, you need to budget, unfortunately, you need to plan, you need to know, well, am I putting this money aside for education? Is it for a holiday? Is it for retirement? And once you've understood what that pocket of money is for and what the time horizon is for that pocket, well, then you can understand or work out what the best investment is for that investment.
Carl, we have a lot of questions coming in very similar to that, but people are wanting to remain liquid because they believe that it's very uncertain times at the moment. So they've got some money, but they're worried about losing a job, losing a home, something like that. So they want as much flexibility as possible. Where can you get a decent return on some cash without locking it in for any period of time?
So you're not locked in, fortunately. If you invest in a unit trust, it's not so much you can't take the money out tomorrow, it's that you don't want the money to be worth half what it is today, tomorrow, when you have to take it out. So most investments these days are incredibly liquid, and you can get your money out the next day, whether it's selling an equity unit trust or a global unit trust or a bond unit trust or money market or money in the bank. So it's very difficult to. There's no one answer that fits every person, but it really depends on that time horizon and the risk you're prepared to miss that investment. So over a 5-year period, there's a much higher. Let me put it this way: tomorrow the stock market is equally likely. You could flip a coin. The stock market is equally likely to go up or down tomorrow. 50% chance. Over a 5-year period, the stock market is likely to go up with a 90% probability. So every 9 coin tosses, you get the answer you want, 1 you don't. So you can start to see that the longer you can plan for, the more certainty you'll have that when you want to withdraw that money tomorrow, that it isn't worth half what it is today. So it's really about understanding that time horizon, because the longer the time horizon is, the more certainty you can have on a high risk investment like equities. And if you can't, if you can't commit to time horizon, if you're worried that you might need the money tomorrow or next week or next month, then unfortunately it's really too risky to put that money into a volatile investment. You really need to put that into something that you can be concretely sure your capital won't be eroded. And there, if you're looking at a week or a month, money market, unfortunately, it's only 4.2%, but it's better than money in the bank at least, and you can get the money tomorrow. And then again, if you can look out over a year, maybe close to 2 years, then bonds become more attractive, and then you can get close to 9%. It's not guaranteed that you'll get your 9% from bond yields, but it's more likely. So unfortunately, the longer you can commit, the more certainty there is, and you can get a higher return. But in the short term, it really becomes a gamble, and it's difficult to commit to anything.
But Carl, let's actually go on to that. If you put your money into a money market account at 4.25%, and inflation is running at what, 5%? So before tax, you even have a negative yield, and the receiver is going to take 35, 45% of that. So in fact, you're diminishing your capital base every year by keeping your money in cash at those sort of return levels.
You're spot on. So with all investments, you have to balance two things. So I'm trying to get both hands in the screen. There's two things to balance. It's inflation risk and it's capital risk. So on the one hand, you can negate capital risk. You put all your money into money market and you'll never lose any capital. But you're right, over 20 years, that money is going to be worth half of what it is in real terms. On the other hand, you have inflation risk, and that is best dealt with growth assets like property and equities. So you can invest in that, and you can be very sure that over 20 years, those assets will keep up with inflation, and you're more likely to be able to buy more loaves of bread with that money than you can today. But tomorrow, that money could be worth half. So it's the balancing of those two risks. Fortunately, inflation is something that erodes over time. So you don't have to worry about inflation risk in the short term. So again, it depends on your time horizon. If you've got 20 years, then you need to worry about inflation risk. You need to focus on growth assets, equities, and property. If your time horizon is tomorrow, you need to worry about capital risk, and you put your money into money market portfolios. So depending on your time horizon, that will decide whether you need to worry about capital risk or inflation risk. And that'll also allow you to focus on the more appropriate risk and take the more appropriate investment.
So, Kyle, I presume you're probably 30 years away from retirement. Where's your money?
I love what I do, so I'm hoping to never retire. But so I have all my money, literally 100%, and that's probably more than that because I do have a bond, unfortunately. So geared exposure to Signia products. As head of investments, I firmly believe that I need to make sure I'm fully focused on those products, and I have 100% on those products. So my retirement assets are on the Skeleton Balance 70 fund. That has to be, it's Reg 28 compliant. So unfortunately, you can't have more than 30% offshore, and you can't have more than 75% equities. So it's not the most aggressive portfolio, but it is the most aggressive you can get within the Reg 28 retirement framework. And then discretionary savings, which I don't need any time within the next 5 years, I have that invested in offshore equities, where I think you're probably going to get your best long-term real return. And again, it spread across our passive global funds, our health innovation fund, our fourth industrial revolution fund. I've got a nice spread. The core in the index, low risk, low cost index, and I've got small pots in the higher return, higher risk buckets.
Right, so quite a diversified portfolio, which is exactly what you recommend. And with your long-term horizon, you've basically got that full mix.
Very boring, but it's what I do and it's what I believe in. So unfortunately, no Bitcoin. I wish I could have retired already, but no, sticking to the plan.
Can I just quickly get in with a few questions from the audience, maybe? Adam asks, ILBs give you a real return of 4% in South Africa. I'm not sure what an ILB is. Maybe why can't you invest in those?
We do. So that's part of our balance funds does have an exposure to inflation-linked bonds, and that's a really good question. So inflation-linked bonds are giving you 4% real, and that's so you don't have to worry about inflation risk, and it is a great investment. But if you had to assume what inflation is going to do over the next while, say inflation is going to give you 5%, then you're going to end up with a 9% return. Nominal bonds, our all bond fund is at 9.3 or 9.2%. So you are getting slightly more by investing in nominal bonds, but you are taking on inflation risk. So again, it depends on your risk appetite. If you don't want to take on that inflation risk, you can invest in inflation bonds, and you are guaranteed to get that. Well, if you hold them for the life, 30-year bond, if you hold that bond for 30 years, you will get inflation plus 4 each year as it comes through.
Okay. Oh, sorry, I know you've got a lot of questions, but we do have to also move on. We're going to come back and have a bigger panel at the end. But you want to ask one more question and then we
one more question to Kyle. You said that you still had a bond, yet you're investing discretionary money in other assets. Is that the correct strategy, or should people look at paying off as much of their bond first before they start investing in other assets?
That is a great question, and I'm sure you'll get different answers from different people. Certainly, one of the best returns you can get is by paying down your bond. Certainly, it's tax-free, so you're not going to pay any of your yield to SARS like you do on money market or bonds, and it reduces your risk. So that now we're not talking about time horizon, we're talking about a risk appetite. So if you do have a high risk appetite, then you are able to take on some gearing. But I have a bond against my house. Over 20 years, a bond is likely to be a good backing against a house. I don't think I'd be brave enough to borrow money to invest in the stock market, but I do feel brave enough to borrow money and invest it against a fixed property. But again, it depends on your risk appetite.
Dina, we'll be back with more questions a bit later.
Absolutely. So thank you. So yes, one of the questions actually had come in regarding the bonds. So thank you so much for asking that. I know there's also a bunch of nuances if you want to buy property offshore, but we'll get to that as well. So thank you so much, Kyle. It has been extremely enlightening, and you'll join us now shortly as well for additional questions at the end of all the different panels.
Great. Thank you, everybody.
Thank you so much. All right. So next we are going to be moving on. We're going to be talking to Jarrod Cahn. Jarrod joins us from London, from Credo Group. And I know that you have joined us before. So thank you so much for actually joining us this evening. And from I don't know, is it a bit of a freezing London? Are you playing in the snow?
Actually warmed up considerably. Last week was freezing. It was 0, -1. Actually, the last few days have been 10 degrees. It's like spring here. So big difference.
Spring, yeah. Well, it's fantastic to have you back. Thank you so much. So I know you were listening to what Kyle has said. I know you've got strong opinions as well. I mean, obviously being based in London and being in this sort of market forever, you've seen the changes, you've seen the shift, the dips. I know you agree in terms of the healthcare and the different equity classes and different other asset classes. So give us your view. Where are you saying we should invest money in terms of stashing your cash, in terms of from obviously time horizons and amounts of cash available? What would your view be?
So, I mean, I think Kyle did a great job in terms of giving the whole spiel in terms of where the layout of the land is right now, and it's not that different, I imagine, in South Africa as it is in developed worlds. In fact, it's worse in developed worlds, because in South Africa, in the bank you can get whatever is 6, 7, 8, 9%, whereas if you put your money in the bank in the UK and the US and any other sophisticated market, you're getting close to zero. And in fact, if you put it in treasuries or bonds, the real returns are close to zero. So if you look at money market funds or money market or cash, the returns are non-existent. If you look at bond market, which historically has been slightly better returns, again, the yield's been squeezed out so excessively that you have to go so far up the credit risk curve, so as to speak, to get any kind of return. And the question is, are you willing to take the risk on certain credits, double B, C credits, from a rating point of view, to get a return of 2, 3, 4%? And again, it depends on your time horizon. So you've almost been squeezed out of that market as well. Then you're left with the property market, and property investments are quite interesting. But the big problem with property markets is it's not a readily available investment. And if you went directly, you have illiquidity problems. So I think that's a big issue. And there are structural changes that are happening, with COVID, and we're going to see what's going to happen as we come out of the other side of this. So I think everybody has been forced into the equity markets. And as Kyle has said, the equity markets, generally speaking, are screening very expensively, particularly on a historic basis. So your expected rate of return that you're going to get out of equities has to be lower than you were getting a few years ago. But having said that, when you put all of this into the mix, it's kind of like the, you know, the beauty pageant. It's the prettiest sister that you've got that's in this parade, and you've just got to choose the best of a bad bunch. But you know, we're not. I mean, Kyle, you know, also painted a very quite positive picture, I'd say, about equity markets. I mean, we are in the same kind of vein in terms of, I think there is still a lot of capital to be gained in equity markets, but you have to go in with the reality that there are certain sectors that are a little bit overheated right now, certain geographies possibly that are overheated, and you've got to be far more selective than you had been, you know, certainly going into April, May of last year. So the only place, unfortunately, to stash your cash, I think, is equity markets. And that does throw up the big issue from a risk profile point of view of investors who have a shorter time frame. So if you are, you know, young, you should be putting a lot of money aggressively into the equity markets. And that just, you know, that goes down on a sliding scale. As you get closer to retirement, you need to conserve capital, and it becomes problematic for people who have liability matching issues. So, but again, you're forced into the equity markets, and there are ways to play that. You know, there are some very high dividend yielding equities in the international market, particularly the UK market, still yielding, even the FTSE 100, you know, still yields somewhere around 3%, I guess, which isn't too bad. So again, I clarify, everything I'm speaking about here is offshore. I don't deal, or we don't deal with anything in the South African. This is all offshore. So I just need to clarify that. So yeah, I think equity markets are the place you need to.
Yeah, absolutely. And
sorry,
so obviously, yes, as you say, everything you do invest in is offshore, not in South Africa. But there is a potential for South Africans, because people also are very concerned. Normally, they don't know. So I've got my money in South Africa. I know I need to invest offshore. How do I do that? So in South Africa, obviously, you've got a single discretionary allowance, which is your 1 million rand allowance a year. And then you've also got your FIA, which is your foreign investment allowance, which you can apply to SARB, which is a 10 million rand allowance. So just to give our viewers some context. So you can take R1 million offshore, invest it overseas, no problem whatsoever. How would you do that? Explain it to our viewers.
There's also one other thing that you can do, which is an asset swap, which you know is so let me go with the IFA is quite simple. I think the million, the first million is very easy to get out. You don't need any type of real authorization from the authorities, but the 10 million you need to get a tax clearance certificate, and you would speak to your tax advisor, and once you have a clear bill of health, you just go to your institution and they'll arrange it for you, and you just do a swap out into whatever currency you want, and that would go to your offshore broker, someone like ourselves who are, you know, wealth manager. We look after private clients. It's our bread and butter. We've been doing it for the last 20 years. So, you know, that's the way you do your foreign exchange allowance. If you want to take out bigger amounts, you have something which is called an asset swap. And an asset swap is something that has grown on the back of what big institutions have. So the institutions in South Africa have always had a capacity to take money offshore. I think, off the top of my head, I think it's 25% of their balance sheet, which they've never utilized to the full extent. So what they then do is allow their clients or customers to then piggyback on the back of that balance sheet and then take the asset swap on their behalf, and they charge a fee for that. So you could effectively go to any one of these institutions, you know, Mutual, Sanlam, Investec, all your private banks, and you could take out an asset swap for a significantly bigger amount, and they will arrange that for you, and the fee, you know, varies depending on the size. And the only limitations to the asset swap are that the bank can effectively call that asset swap back at any point in time. Although I experience over the last 15 years is that we've never had that situation. And you're also slightly restricted in terms of the assets that you're allowed to invest in the asset class. So the most basic one is that if you took out an asset swap with Investec, you can't go and buy Investec paper or anything related to Investec in terms of a subsidiary, et cetera, et cetera. So it's not, you can't reinvest in the same company, and you can't invest in illiquid investments. So property, unlisted properties, etc., and things like that. So there are various restrictions, but for all intents and purposes, most vanilla investments, anything you want to buy on a regulated equity market, be it fixed income, be it equities, be it hedge funds, you can buy. And it does give you, obviously, access to a larger offshore exposure than your traditional foreign exchange allowance. Sorry, Dina, you were on mute there. Yeah,
I was on mute there. Apologies. All right. So no. So in terms of the different options, obviously, so you're looking at, you're in the UK, but are you investing in the US market? So we've seen that the US market has had quite a run. So potentially those equities have already sort of been priced out in terms of being expensive for what they are. You've got the UK, you've got Europe, you've got Japan. Where are you investing? Where are the opportunities, and where are you seeing the growth?
I think, it follows in terms of where the best economic outlook looks for the world. And this depends quite largely on a number of things. The vaccine rollout has been mentioned. I think it's a huge, huge issue in terms of how quickly various world economics can get back on track. So we've seen that, Israel is a great footprint in terms of what we can expect, and the rollout there and the success of the vaccine has been very pleasing in terms of just the traditional old, COVID variant the traditional COVID variant. The problem that we're facing now is you're seeing new strains, the South African strain, the Portuguese or Brazilian strain, the California strain, etc., and how the world is going to adapt to that. But we take comfort from the fact that there isn't just one vaccine provider. You have 3 or 4 mRNA vaccine providers in the likes of Pfizer and Moderna, etc. And then you have the Johnson & Johnson, and you have even Sputnik or the Chinese. So you have various providers. And what is quite pleasing is that although, even today, negative report in the FT to say that, the mRNA vaccines aren't reacting very well to the South African variant, which is not great news. But Moderna, which is a company that produces the mRNA vaccine science, already working on the next variant. They're working on the mutations, and the FDA in America is working very closely with these companies and giving them huge leeway to administer booster shots in a very very short space of time. So we don't know where it's all going to end up. 12 months ago, and we can see, that we're getting to a level where these vaccines are working, and they will slow down hospitalization and mortality rates. They may not, slow down the actual disease itself, and we're probably going to have to live with the disease for the foreseeable future. But the point I'm really getting to is that, the US is well advanced, although they're quite slow in terms of the rollout. The UK is the most advanced in terms of the EU and the bloc. So once we can get back on our feet, you can see where things are. To put it in a different way, I think, we've always tended to invest in US and the US companies, and that's mainly been because that's where we found the best companies in terms of the best technology, the best management, the best corporate governance. And to a less degree, certainly the UK has similar variants. I think in Europe, it's bogged down by a lot of regulation and very poor management. And also, you have historical levels where family-owned businesses aren't really managed in the best way for shareholders. And I know it's a huge generalization. So where we've been positioned historically, we actually are bottom-up stock pickers in the main, but we have been very much focused, and I talk of our fund here, the Credo Global Equity Fund. We've had about a 65% or 70% weighting towards the US and North America, and only around about 12 to 15% in the UK, and then ancillary markets. And I think going forward, the best companies again remain in the US, so we will tend to buy those companies. But having said that, we are seeing quite stretched valuations in certain sectors. The technology sector is an obvious one. It did very well during the work from home April through to November environment, where they managed to, gain huge market share and have very little disruption to their business models, whereas the cyclicals or the non-stay-at-home or the rotation stocks didn't perform well. In November, we had the kind of flip of that, and now we're in no man's land, depending on how quickly the vaccine rollout will actually take place. But we still like the US. But having said that, if I think of the last few purchases we've made for our fund, they've actually tended to be in the UK. So you've had some laggards there in the leisure sector, in the luxury sector, and just generally the UK has been dogged by Brexit. It's been dogged by low valuations, and you have quite old economy stocks, the mining companies, the pharmaceutical companies, the banks that dominate the index, which obviously has led to weaker performance of that index. So we're picking and choosing. But again, I think we would, I think America is still the place to be, but not necessarily the sectors that have been the sexy sectors of 2020.
So would you say, in terms of the tech sector, that it has sort of run its has run its course? So if you're looking at the Amazons, you're looking at the Zooms, you're looking at Apple, Tesla specifically as well. I mean, which we've seen outperform.
So maybe I would maybe rephrase it not as tech stocks, but maybe as growth stocks. I think the growth stocks have had a phenomenal run, and while interest rates are close to zero, and the discount rate, which you plug into all these models in terms of valuation, are basically free money. People are willing to buy growth stocks, and they're willing to, buy the electronic vehicle, the Tesla of the world, on the hope or the theme that they're going to take over the world, they're going to dominate, and you don't care what the valuation is. It's just about market share growth and being the dominant player when it all settles down. So that's what's happened, and it's problematic. So you've got to, again, be quite selective in terms of the stocks you own. So the EV stocks, the Teslas, I wouldn't go into anywhere near. Some of the FANG stocks are actually are screening quite attractively. I think Facebook is one which you could buy. Facebook actually trades at a discount to the S&P index. If you strip out the cash component of Facebook, it trades on a 17 times multiple. The S&P trades on 21, 22 times. I don't think that's excessive. Apple trades at a premium. I'm not too excited about Apple. But again, if you look at Amazon and Apple over the last 2 months, they've actually flatlined. They've underperformed the rest of the market. So I think you could see that kind of theme of technology or growth companies kind of flatlining. I'm not saying you'll lose money on them, but they will underperform other sectors in the market. And I think those are that's the nuance that you've got to take as a stock picker. Picking the right sectors which you think are going to outperform. So clearly the ones that have underperformed have been the leisure sector, the travel, the more cyclical kind of companies. And I think they are starting to have the rally. The banking stocks, we are starting to see a bit of a tweak in interest rates, certainly in the 10 and 30-year treasuries in the US. So we could see a continuation of that momentum going forward through 2021.
Fantastic. Thank you. So I just want to say thank you so much. I know we're going to come back as well. We're going to have a general panel. Howard, before we move on, I also wanted to show a video because I know Credo obviously are one of our sponsors this evening, and we're going to have a quick short poll. So Danny, I know we'll come back now with the questions, but Danny, can we run the video from Credo, please?
Credo has been helping the South African Jewish community invest globally for more than 20 years. Our range of investment solutions includes the Credo Global Equity Fund, a collective investment scheme subject to the highest European regulations. The Global Equity Fund allows investors to access top-quality global companies in a liquid, tax-efficient structure. Find out more by asking your financial advisor or speak to Credo directly. Talk to us today.
Thank you so much. And I know we're also going to run a quick poll. And again, this is just to see for people that would like to contact you and to actually find out more and how to invest, obviously offshore, then you can just obviously look, would you like to receive more information from Credo? Yes, I would like to explore investing offshore. Yes, I want to know about your global equity fund. And yes, I want more information on your other investment options. Okay, so we're just going to leave that on for about a minute and let people just vote so that people can actually be contacted if they're interested. Again, we are looking globally and locally, but obviously you can invest rands offshore. So very, very attractive, and lots and lots of information, lots of options in terms of investments. So let's
Dina, there are a few questions for Jarrod that have come in. So if I can ask him just to turn on his camera.
Sorry, Howard, if I could just interject quickly, I've also placed a link on YouTube for anyone who wants to answer the poll and get information from our sponsors can do so.
Thank you so much.
Thanks, Danny. So Jarrod, people want to know, how big is Credo? How much money do you have under management?
We have about 4.2 billion sterling under administration.
So that's what, about 100 billion rand, somewhere around there?
So what? Yeah, exactly. Yeah, so it's quite a significant amount of money. It is split up between discretionary managed money and then advisory money. So about half of that is discretionary.
And then questions coming in about what's the minimum amount that someone can invest with Credo?
So again, it depends on the investment product. If you're looking for a bespoke portfolio, it would be £250,000. But if you wanted to buy one of our funds, the Global Equity Fund, the Dynamic Fund, we have a few funds. Minimum investment there is between £5,000 and £10,000. And obviously we have the South African Feeder Fund, which is in Rand. So if people didn't have money offshore, they had it in South Africa, but wanted diversification in Rands to a Global Equity Fund, you can buy the BCI Global Equity Feeder Fund, which is on various platforms as well.
And what's the minimum on that?
It's small. I mean, it's a unit trust. It's a collective investment scheme. It's regulated. So I think it's a few thousand rand. I'm not actually sure off the top of my head.
Then Jarrod, a question coming in. Do you have a South African office, or does someone have to deal with you in London?
No, we have representation in a number of the provinces in South Africa, Joburg, Cape Town being the main hubs, and I can certainly put you in touch with the various people if you like.
Natalie Gordon is asking a question about wrapped funds. Is that something that you want to comment on at all?
Yeah, I mean, I would have thought this that the South African tax planner would probably have a better handle on that. Yes, I mean, wrap funds are interesting. I think for South African investors who have offshore investments and they're looking to from an inheritance tax planning, from a CITES point of view, it is very interesting. There is a cost that is associated with it, and it's something we can obviously facilitate in terms of the management of those wrap funds, and we can put you in touch with various providers in South Africa who would obviously then wrap that for you, and then we would look after the underlying investment in the wrap funds.
Great, thank you. We'll be back a little later with some more questions for you.
Great, thank you.
Great, fantastic. So thank you so much. So I know we've closed that poll. So hopefully those people will be contacted. And now we are going to be moving to Sisandile Cikido, who's the head of retail investments at Nedbank. Let's just start her video and get her to unmute, please. Sisandile, are you with us?
Hi, yes, I'm here. Thanks, Zena.
Hi, how are you? So lovely to have you. You said you're small, and you said, but we can't see it. It's Zoom, and that's the benefit of digital technology.
I'm grateful. I'd be in heels anyway if I was standing in front of everyone.
Well, it's absolutely lovely to have you with us this evening. Thank you. So Sisandile, I know that, so you're the head of retail investments in Nedbank. So obviously you are very close to this, where people are literally looking at their investments, how to maximize their investments, how to basically make the most of their money, how to maximize their interest rates, whatever it may be. Tell us, what is your view, and what do you suggest for clients, and what are the products that you are actually recommending to clients?
So I think, like my fellow panelist said earlier, Kyle, if you're not in a tax-free investment, for instance, you're doing yourself a disservice or an injustice. So tax-free investments, whether they be with Nedbank, which will be an on-balance sheet type of product, or with our partners at Net Group Investments, where it's more of a unitized trust, you should be having a tax-free product within your investment portfolio. Because as you know, when you earn interest on any investment, you have to pay tax on that interest. And we have various interest thresholds, annual interest exemption thresholds. And if you're under 65, it's around 23,800. Over 65, it's 34,500. But if you do earn interest that's more than that, you would then need to obviously pay tax on that interest. So to kind of put it into rand terms, if you have an investment of 300,000 and you're earning an annual effective rate of 7.5%, you're looking at an interest of about 22,500 rand. So if you've got an investment of, say, 500,000, you're going to be earning more interest than that, which means you then obviously have to pay tax. So if you don't have a tax-free investment in your portfolio, you're not doing yourself a favor. In fact, if you are not doing this for yourself, you're taking money from your basket of investments.
Great. And also, so we've talked about, I know that Kyle and even Jarrod alluded to like the long-term sort of view on your tax-free. So
100%.
Yes, you've got your, every single year you're allowed to put a certain, the 36,000 individual, and you can also do it for your children collectively. So where at what point in that horizon is it the most beneficial from a tax point of view?
So I like to personalize money because I think it's such a touchy subject for me, right? And when people say money isn't a touchy subject, I always ask them how much they earn or challenge them to tell everybody how much they earn. And no one's ever willing to do that. So for me, I'm 35 years old. In 15 years, I will be 50? And in 25 years, I'll be 60 and I'll be approaching retirement. So if I take 36,000 Rand every single year for the next 15 years, and I allow my interest to compound, which means I don't withdraw and I don't take out of my interest, I will be looking at an investment of about R1 million in the next 15 years. And obviously that's at if I'm looking at an annual effective rate of about 8% per annum. That's R1 million of money that's just sitting there for me when I retire. And if I let it sit there for an additional 10 years, I'm looking at 2 million Rand. So I'm also at a point in my life where I'm planning to have a family, right? And the minute I have my child, I'm thinking, what can I do for this child that wasn't done for me? So it's important to have a long-term view when you are looking at a tax-free investment. It's not one of those investments where when you want to buy a car in the next 5 years, or you want to take money out to deposit a house where you're going to dip into it. Because unfortunately, the minute you take money out of a tax-free investment, you can't actually put it back. Now you ask me, what do you mean? Because you have a lifetime contribution of 500,000 Rand. And that's broken up into the 36,000 annual contribution, which changed in last year. So, and the year before that, so prior to that, it was 33,000. And prior to that, when this kind of kicked off, it was 30,000. So we're hoping that the annual contribution rate will be high, and ultimately your lifetime contribution will also increase, but we'll obviously hear from the powers that be. So if you do contribute more than 36,000, you're looking at being taxed or penalized for the additional amount at about 40%. So you want to stay within that 36,000. You also want to try and maximize the 36,000 within each tax year. So as we know that the tax year kind of comes to an end at the end of February, if you do have a tax free, you want to maximize it because you want to reach that 36,000, because you want to get the full benefit of your compounded interest. You want to get the full benefit of your 500,000 lifetime contribution, and you want to kind of get there as quickly as possible so that your interest can earn itself. Yeah.
And in terms of, you said you absolutely talked about taking money out, so you should never do that in terms of a tax-free savings account.
Correct. I think if you are not at a point, and I think none of us are, because none of us have had the 15 years since 2015. So if you're not at a point of having contributed your full lifetime contribution, I would strongly suggest that you don't take money out. Also consider when you do open up a tax-free for your child and you want to take money out to buy them a car or to buy them a house, that you're also affecting their lifetime contribution. So my child goes to varsity when they're 18 years old, and I'm like, I can take money out of here to pay for your fees, to do this, to do that. But I am completely affecting their contribution. So they will not be able to open up a tax-free and benefit from a tax-free savings or investment. Just as much as if I have multiple tax-free accounts, I need to ensure that all of them kind of equate to the 36,000 per annum.
Okay, and in terms of, as we've talked about, so obviously they're different vehicles now. So obviously 2015 was the beginning of your tax-free savings accounts, obviously to promote savings within the nation, because we're not so great at that. But so now since then, there's obviously been a proliferation of products. There've been every bank, every financial institution, insurance company, everyone sort of jumping on the bandwagon. What would you say is the best current offering from a tax-free saving? Is it a plain tax-free saving account? Is it something that's got an option to invest in other opportunities? What would you do? What would you give as advice?
So, we've had comments around the value of money in the last, say, 12 months. And we've seen interest rates kind of plummeting in the last 12 months. If I look at 12 months ago, a sort of a bank guaranteed deposit, tax-free, say, fixed deposit was, you could earn up to 8% in terms of your annual effective rate. And that's kind of come down in the last year because of everything that's actually happening in our economy. So if I'm closer to retirement, like one of my colleagues has said, if I'm closer to retirement, I'd probably still stick with a bank guaranteed deposit. But if I'm not closer to retirement, I'd probably take my money and put it in something that's more unitized, that's like a unit trust. Or so I would actually do it that way, yes. But I think it's important to just get started, Dana. It's important to start, whether it's your tax-free savings account or a tax-free fixed deposit. Tax-free savings account you can open up from, I think, as little as 250 Rand or 500 Rand. A tax-free fixed deposit you can open up at it from as little as 1,000 Rand. So to just get yourself started and get into the momentum of putting money away into a vehicle that is completely tax-free is something that we all have to do.
Absolutely. All right, so I know, thank you. So Nedbank is actually one of our sponsors tonight. So we're gonna play. We've shown sort of some of the slides that you've had. We know you've got a whole bunch of the different products. We're going to come back and actually have a collective panel. But I want to get to our other speakers. But I know we also wanted to run a poll for you in terms of people contacting you so that you can also understand what the tax-free options are for savings account. So we're putting this up now. Sorry. So
and Dina, while people tell us if they want Nedbank to contact them about the tax-free savings account, we do have a few questions for Sisa that has come in. So Sisa, someone is asking, can you invest your entire tax-free savings amount up to 500,000 at one go? Or are you limited to a specific amount per year?
So absolutely not. If you noted what I said a little bit earlier, is that none of us have actually reached that threshold because none of us have had the 15 years to kind of contribute annually. So your annual contribution is capped at 36,000 Rand. And unfortunately, anything over and above the 36,000 Rand will be taxed at 40%, which is the additional contribution. So if you put in 40,000, your 4,000 Rand will be taxed at 40%. So that's a harsh kind of tax penalty. So you would need to, unfortunately, stick with the 36,000 at an annual basis, and then you kind of gradually get to your 500,000 lifetime contribution.
And Johan is asking, when you invest in tax-free investment accounts, does it have to all be South African based, or can these also invest offshore?
So as I would like to leave that to my esteemed colleagues who do manage offshore investments, and I'd like to speak to my point of expertise, because on balance sheet investments would obviously be South African.
There's also a question that says, why should I put money into a tax-free account for the long term if A, the rate of return is so low, B, the Rand might depreciate significantly, and C, foreign equities offer a much greater growth?
So by no means am I saying that the tax-free investment should be sort of your only investment kind of tool within your portfolio. by no means am I saying that. I do think your investment portfolio does need to be diversified though. So whether you do go into equities and offshore investments, you're probably going to pay tax on the interest that you earn. So in this situation, if you open up a tax-free investment account, you are going to get the money that you put in without having to pay anything over to the receiver. So I think if you're not taking advantage of that and you're weighing up against what you're earning and being able to pay interest, by all means, if that works for you and you're able to invest that much amount of money, by all means do so. But I think for general South Africans and most of us who don't have that amount of money to kind of cover the deficit of what we'd be paying in tax, it is definitely a tool that we'd like to look at too.
Di is asking, does your age influence the decision to have a tax-free investment, or should you just start as young as you can?
I think we should start as young as you can. I think I always say to my family, I wish they taught me more about money growing up. I wish the conversation had gone further than money doesn't grow on trees, because that's all I ever heard growing up. So I wish the conversation had.
Don't worry.
I wish the conversation had kind of grown into what are you going to do with your money? If you're using 10 Rand, are you putting away 2 Rand, etc.? Because then if I look back at when I started working about 15 years ago in a very junior role, straight out of school, I wish I had done things differently. I wish I hadn't bought the cars. I wish I hadn't bought the cars to impress people I don't even like or people who don't even like me. So if I could go back to my younger self 15 years ago, I would definitely have started. And obviously, if there was such an offering 15 years ago, I would have started something like that. But I would have also obviously had to have the conversations. And like I said, in a position where I'm planning to have a family, I'm going to start as soon as my kids are born. I'm going to start a tax-free savings for them because I want them to be in a better position. So I always say, what if my child has a conversation with me in the next 20 years, I want them to say, thank you, not what were you thinking?
So 2 very, very quick questions that maybe we can do as one-word answers. Can tax-free investments, do they have to be in trust, in cash, or can they be in unit trusts? See, so you with us?
They unit trust cash. Both.
Yeah, I think we're having some connectivity. Are you back with us? There you go.
Can you hear me now?
Yes, we got you.
Yes, we can.
Okay, so I'm going to try and say that in one-word answer and say both, Howard.
Okay, fantastic. And last question, do you have to put all 36,000 in, or can you put a much lower amount into a tax-free account?
So you can start with, like I said, as little as 250, 500 Rand in a tax-free savings account. In a tax-free fixed, you can start with 1,000 Rand in a tax-free fixed. So you don't have to put in the 36,000, although that is the max you can put in. But I think to get yourself started, start with any amount that you can afford, whether you're going to build it up monthly or it's a lump sum that you can put in on an annual basis. Just get started.
Awesome, thank you. We'll be back with more questions a little later.
Thank you so much. Thank you, Sisandile. I think you've given us a lot of also info on that, and also guidance for our own kids on what we need to start. So next up, we are going to have Jaco van Tonder, who comes and joins us from 91. Let us just get him there. Jaco, you're on mute. Just unmute, please. How are you? Good evening.
Yes, good evening.
Thank you and welcome. I know we've got a lot. I mean, there's so much content tonight. It's just actually like it's a massive subject. But I know that you have written extensively on tax-free savings accounts and quite passionate about it, and have definitely got strong views on tax-free savings accounts. Can you actually explain to us, like, what are they and how do they work?
Yeah, so I mean, we dealt with a couple of the points already in the previous panelists. So I mean, I'm not going to repeat what she said, but in short, it's something that's available to any South African investor. You can invest in a range of different vehicles, so it's not just linked to a specific product. You can get tax-free savings vehicles across banking accounts, unit trust investments, local investments, offshore investments. I mean, as a matter of fact, we run a product at 91 ourselves, and by far the largest allocation of our assets. We have about 1.2 billion rand last count, and that's before the Feb push that's busy happening. We have about 1.25 billion rand in tax-free savings investments from retail investors, and well over half of that is 100% offshore. So I think it's very clear that there's something for everybody. I think the Treasury opened up the product to a sufficiently wide range of product wrappers and investment options. So there's lots of options for people to pick from. So any South African who's got money to invest, whether you are a miner, whether you are a taxpayer, whether you are not a taxpayer, you are able to take out a tax-free investment, put 36,000 rands maximum, 36,000 a year in there, up to the lifetime cap of 500. And really that's in essence how the product kind of is constructed. I think the key points, just to highlight, because I think we put a lot of work into making sure that people use these things the right way. And I think some of the points came out of the previous talk. It's important to note that these are long-term investments. The reality is you need time for the tax saving. It's not like a retirement fund. In a retirement fund, if I put 100,000 Rand in my RA, I can claim a tax deduction up front. I can get a big tax deduction in my, and that's why a lot of people do that now in Feb. They go through their financial affairs, they do their pro forma tax calculation for the year, they see that they have a certain tax liability, and they look for ways to minimize that tax liability. And one of the ways to do that and save for your retirement is to make a contribution to a retirement fund. And the upside is you get that full tax benefit up front. You can get the write-off against your tax bill up front. The tax-free savings account does not work that way. You don't get a tax deduction for the contribution. The tax deductions happen because you don't pay tax on the investment return. Now, that is both a good and a bad thing. A bad thing because the tax benefit's not up front. You don't get that juicy little thing to stick into your tax statements before the end of Feb. But on the flip side is the fact that if you allow compound interest to do the work for you, the value of that tax benefit, it's minuscule in the first 10 years. In the second 10 years, it grows to about almost half of the value that is in your tax-free savings account comes from the tax break at the end of 20 years. And at the end of 30 years, well over 2/3 of what you have in your tax-free savings account is no longer the money that you put in, it's the tax-free growth that you got courtesy of Treasury. So I think that's, for me, the simplest way to explain to people. If you put money in and you draw it in the first 10 years, you're really wasting that benefit. You're wasting your lifetime limit, number one. And number two, you are not being patient. You're not waiting for the carrot to grow. You're pulling the carrot out of the ground before it's actually properly developed. Tax-free savings might sound, and I don't want to point fingers at other industry players, but I think especially initially, before we understood these products, they were maybe marketed incorrectly. Lots of people marketed tax-free savings as something like an emergency cash stash where you put your short-term cash. Please don't put your short-term cash in a tax-free savings account. As we said in the previous session, you can put 300,000-400,000 Rand in a money market fund tax-free anyway, because you get an interest rebate from SARS every year. You don't have to pay tax on your first 300,000 Rand odd that is in a money market fund. So please put your emergency cash directly in a money market fund, and then put it on top of that, if you've got the ability to put money in your tax-free savings with the time horizon of 20 and 30 years in mind, not with a 3, 4, 5 year. It's not how you save for your next car upgrade, unfortunately. That's not what tax-free savings are all about. And then if you look at the investment options, we've done quite a lot of work on that. The math is pretty simple. A lot of people think, no, I'm going to invest in fixed income investments because that's where I get the biggest tax break. You know, my tax break is 40 or 45% because that's what my tax rate is on interest, and my tax rate on capital gain is much lower. So it must be better to invest in fixed income investments in a tax-free savings account. Again, a classical thought error, because what matters over 30 years is total return. Over 30 years, volatility and noise and all of those other things fall by the wayside. Even over 10 years, it falls by the wayside. What you really want to focus on is total return. And total return comes from having proper growth assets. And that's the way you should structure your tax-free savings. Put a lot of it offshore because there's no restriction, as opposed to your RA where only about 30% can be invested offshore. Tax-free savings have no implicit limits. you can put 100% of it offshore, and many people do exactly that. And it's a great option for yourself for 15, 20 years down the line, whether you are 20 years old today, whether you are 30 years old today, or whether you are 50. I think it's still you still have enough time left to benefit from those tax-free compound interest investments, and that's how you save yourself rich.
Fantastic. I think that gives us a lot of context and also a lot of insight in terms of your RAs, your retirement annuities, and that. Can we talk about also the wrapper? So obviously someone earlier asked about the wrapper. Do you want to give us more information? So you do those wrappers?
Yes. So a number of financial services institutions, based on different licenses that they hold, are able to offer tax-free savings. So banks can offer them. Unit trust companies, or as they're known in the law in South Africa, collective investment schemes, can offer tax-free savings. And also some of your investment platform products, they are allowed to offer tax-free savings. And what really is different between dealing with these different types of license providers is the range of investments that you get and the type of investments that you get. So the on-balance sheet stuff at the bank is likely to be very fixed income focused. The options you get from a unit trust company will generally be maybe 3 or 4 different funds from that management company's range, but it will all be from the same company. So if you buy them from a well-known unit trust brand, you're likely to only get that unit trust company's brand. If you take out one of these investment platform tax-free savings accounts, they tend to offer you a range of funds, 15, 20, 30 funds across a number of different managers. So I think it makes it administratively a bit easier if you go for the kind of a platform option that's got a few more tax-free savings investment options, because you know how people are. You buy an investment today, and even though it might have done really well over 5 or 10 years, at some point people feel this need to make a change. And then when you want to make a change, you want to have other options available. And that's when it's nice if your tax-free savings provider actually has options available, and then you don't have to transfer the thing. I mean, transferring a tax-free savings product from one provider to another is a bit of a mess, actually. It's quite a complicated administrative thing to do. So you can avoid all of that if you're just with a provider that's got enough options that you can make those changes without having to actually move the money from one tax-free savings product to another.
Fantastic. So I saw how it popped up, because I know there are questions that are coming in through the chat, because people are also asking is if a tax-free savings should be seen as an additional savings product to supplement your retirement savings, and if you should choose from different portfolios so one can get better returns.
Okay, so I think the question about tax-free savings versus retirement funds is a brilliant question, because people who are quite sharp around their financial affairs quickly cotton onto the fact that both of these are tax efficient vehicles. Now ordinarily I would say, and I say ordinarily because there's been a lot of bad press around retirement funds in the last 12 months when the rand was at 17 against the US dollar. People desperately wanted to take more money in their retirement funds offshore, and they were all hitting the 30% regulation 28 cap. And lots of people were desperately unhappy with that. And there was a significant amount of press, and we had press around prescribed assets and all sorts of things. So there's a lot of tactical noise last year around retirement funds and whether they are really good long-term options still. If you look at it cold and clinically, the tax, we've gone and kind of calculated what the tax benefit that you get in a retirement fund in South Africa is worth over your full lifetime. So when you start at age 20, you retire at age 65, you draw an income until you pass away, and you get, a certain beneficial tax treatment over that, say, 60 years, 40 years or 35 years of saving, and another 20 or 30 years worth of drawing an income. If you calculate the tax benefits that you get and you work out what is that worth, if my other option was to not invest in a retirement annuity, but to just put the money in my own investments, no retirement annuity close. It's my own voluntary investment. I can take the money whenever I want. I'm not subject to regulation 28 restrictions. I can invest it 100% offshore. I mean, that's the sell. So what is the difference between those two? And really the tax benefits on the retirement structure we've calculated comes to around an additional investment return that's available to the investor of 2.5% per annum. So if you want to take your money and invest that in some other vehicle that's not a retirement fund vehicle, so you don't get any tax benefits. So it's not a tax-free savings account. It's literally you're just buying an offshore investment and you're paying your tax the normal way. That investment needs to generate over a 50 to 60 year period an outperformance of 2.5% per annum to beat the retirement fund structure in South Africa. That's what the tax breaks are worth. Now, 2.5% per annum might sound to a lot of people like not a lot of money, but to do that consistently for 60 years, it's almost impossible. There are very few investment options. You're really starting to kind of border on saying, that the country has to almost go under for that to happen, because in the normal course of events, even with political strife and with political upheaval and change, as we've seen in the country in the last 50, 60, 70 years, the investment performance numbers have always kind of been there, and it's tough to outperform by 2.5% per annum. So my normal comment to people remain that unless you're thinking of emigrating from South Africa and you're really thinking of doing that really soon, it's hard to beat the value of the tax break that you get on that retirement fund structure. So first, make sure that you're making a contribution to a retirement fund. And then once you've sorted that, on top of that, if you have some extra money available, put that into your tax-free savings account every year, either on a monthly basis or top it up in Feb if you're able to do that. Maybe whenever you get a bonus, take some of that money and put it into the tax-free savings account. That would be the way that I would structure the retirement fund versus the tax-free savings. The ideal is to do both, but if you can only do one, it's probably better to do the retirement fund because it's got more legs. But I would really try and do both if at all possible. And the only time that I wouldn't do a retirement fund structure is if you are really planning on emigrating, your plans are in place and it's kind of happened somewhere over the next 5 years, then that's a different story. And I think a good advisor is really how someone can get a good nudge, depending on which way they want to go with their lives.
Okay, and also I wanted to ask, can you do a tax-free savings account not in your own name, in a vehicle, in a company where there's additional benefits?
No, so unfortunately it's linked to a tax-paying individual in South Africa. So you can do them for children, you can do them for people who are retired, you can do them for people who are working, but you can't put them, as far as I am aware, you can't put them in a legal entity, unfortunately, not a trust or a company.
Okay, how you got some questions?
Yeah, Jaco, I wanted to ask questions about 91 because 91 is what people remember as the old Investec Asset Management. It changed its name. How big is 91? What's the value of assets under management?
I've got the sterling number for you, and it's now that we are listed, I have to be careful which date I give you to. But the official number that I've got here, which was towards the end of 2019, was about 121 billion sterling.
So that's about what, two and a half trillion
rand.
2.5 trillion rand.
Correct.
Okay, substantial player.
Yeah, we are. If you're thinking about the South African roots firms who grew up in South Africa, and who are in the asset management industry, you're thinking of all the big life insurers and all the big private investment managers who have their roots in South Africa. We are the largest.
And Jaco, let's talk about your personal investment strategy. Where have you put your money?
So as a South African, I think that the way to do this in your strategy kind of changes as you age and you earn more money and you potentially are able to pay off your house and you get some free cash flow as your bond installments become less or they fall away. So I think your saving strategy kind of evolves over one's lifetime. I mean, if I can kind of relate mine a little bit, my first strategy was to get rid of debt, but to continue saving. So I saved for retirement from the first day that I worked. And for my sins, because I studied financial services, I understand the power of compound interest. And I know that if I save for retirement over 40 years, the money that I put in the first 10 years of that 40 years, when I'm in my 20s, I don't care if I'm flipping burgers at McDonald's, the money I'm putting into my retirement fund between age 20 and 30 grows to almost half of my retirement pot by the time I'm age 60. And it's just because it's the money that's been in the markets for the longest. So I understand that power of compound interest. The pittance that you earn if you're the clerk CA, or you are starting out in a company and earning a low salary, the pittance that you contribute to your retirement fund actually grows to about half your retirement pot at the end of 40 years. So I think do that from the very first day that you start working. Sign up for your company's pension fund. Please don't neglect that. It is absolutely critical. But once you've got that box in place, you're obviously going to rent for a while, then you're going to buy a property. Once you buy the property, the objective should be to pay that off as quickly as possible. That maybe means not upgrading to a new car every 3 years, but maybe only upgrading to that new car every 6 or 7 years so that you can get that property paid off as quickly as possible. And then once you start getting that property paid off, you start getting free cash flow. Take some of that free cash flow from that bond installment and start investing that. And that should ideally happen kind of by your early 30s. You must be starting to building your private investment portfolio with hopefully the money that kind of come from your bond. And then over time, you use some of that money to pay off your cars so that you have your cars cash. So you're not actually having to sell your car and then put a huge amount of money or take out a huge installment loan to pay for the car upgrade. You slowly but surely you get ahead, and every little bit that you get ahead, you make a point of putting some money offshore, because I think that's where, as your asset base in SA around your house, and your car, and the other things that you need to be able to live here, as that gets paid off, you have the ability to diversify your investments now. So up to that point, almost all your investments are in SA exclusively, and then I think you need to push aggressively to invest more and more money offshore. When you've got your vested SA asset base in place. I mean, I'm always amazed when I traveled overseas for the first time for business many, many years ago, and I started talking to people in other emerging economies, talking to private bankers and advisors in countries like Chile or India. And I asked them, how much of your clients' money do you put overseas and how much do you put in your home country? And I was amazed that almost without exception, everybody was putting more than 50% of their investment assets overseas. And that was not because Chile was in a crisis at the time or India was in a crisis or having a political crisis. That was just the accepted norm. You've got so much assets in your home base that your free assets that's in cash should be at least 50% invested offshore. And I think that should be the objective of a South African investor as well, is look to be growing that offshore investment piece slowly but surely, either through rand-denominated investments or taking that 1 million allowance every year, and every now and then if you get a good bonus or you sell a business and you make some money, make use of your 10 million annual allowance, get the tax directive, put the money offshore. I think it's a good balanced approach, and that way you grow the wealth.
Well, I think you've just given us the total path to complete financial freedom. So thank you.
It does not involve investing in Bitcoin and praying that it goes to, that it doubles or triples in value.
No, listen, it's all very sound advice. But what we do want to do is play your ad from 91 because we know you're sponsored. We want to run your poll and we'll ask you one more question. So, Danny, let's run the ad for 91 and then we can do the poll. And Fantastic. And now, Danny, we're going to put up the poll while we run that. As we know, we can see that 91 is no small company, and to have grown the way it has with competition in the UK, it's just actually phenomenal, to be quite honest. So let's put up the poll, 91. So would you like to open a tax-free savings account with 91? Yes, I want to open a tax-free savings account. 2, I already have a tax-free savings account, but I want to reinvest for another cycle. 3, I want to top up my investment and reinvest for another cycle. And 4, I want to explore other products. Okay, so as you said, absolutely start as young as possible, and the power of compound interest cannot be beaten. Okay, Howard, I know you had one more question.
I'm going to try to sneak in 2. One question comes from someone who says they're 58. Is it too late for them to put into a tax-free account? Will they still see benefit if they don't have like another 30 years of runway to go, or is benefit seen from day one?
So I think the minimum term that you should take it out for is 10 years. I mean, if you're 58, I mean, unless you are in poor health, you're definitely expected to live for another 10 years. So I would say definitely at 58, it's easy. As you start getting to 70, I think it becomes less easy. You know, you never know. You might live longer. People are, I mean, if they make it to 65, 70 nowadays, we're finding life expectancy shoots up quite sharply, and people can easily live to 90. So I think they shouldn't worry too much about the term of the investment. I mean, there's no real downside. I think that you're not giving anything up. It's like a tax-free option that government gives you, and they don't take anything away from you up front. So there's no real downside. If you do use it, the credits are there. So I would suggest, irrespective of your age, you know, contribute if you can, the 36 every year.
So, Jaco, I want to ask one last question, and it's going back to the last question. You gave us a magnificent answer on personally how you think you should evolve. But let us take a point in time. Let us take, say, age 55.
Yeah.
What should your portfolio look like by the time you reach age 55? How much in South Africa, how much offshore, how much in bonds, how much in property? Like, give us a sense that kind of at that point in time, someone probably got another 15 years of work ahead of them before retirement, life expectancy into the 80s, 90s. What should your portfolio look like at age 55?
It should not be in fixed income. So it should be very much in growth assets, because you have a long runway left. So I would say actually, I mean, some of the only time it makes sense to start converting your asset base to cash is obviously if there are serious health related issues and one is actually making a 5-year plan. But if in the absence of being in that situation, if you're normally in average health and average life expectancy, I would say age 55, you've got a long runway left and you've got a plan appropriately for that. So even if you retire at age 60 or 65, there's no need whatsoever to do an aggressive switch into some fixed income assets. Even at age 60 or 65, a growth equity exposure between offshore and South African equities of about 60% is completely appropriate, 60, 65%. I think one should be very careful of dropping one's portfolio allocation to shares below 60%. It's in rare specific financial planning situations where you're aiming for a specific outcome at a certain date, where then it might be worthwhile. But otherwise, I wouldn't, in the normal course of events, even for people in their 50s and 60s, suggest that they cut their equity exposure aggressively. You know, it might be that you're trying to deal with a very specific cash flow problem. It might be that the person hadn't saved enough for retirement, but I mean, that's a whole different problem. If someone hasn't saved enough for retirement, you can't fix that by tweaking asset allocation. That kind of becomes a social security problem, and you have to identify it correctly and deal with it correctly. So if someone has just about enough money to survive for retirement, I'd say 60% equities, and of that, probably at least half offshore.
And property?
Property is an interesting. You can almost have a complete session on property in South Africa. I remember when not too long ago, I had a call from one of our analysts in our investment team in the US, a new US analyst. And he phoned me and he said he he's sure that there's something wrong with one of the indices that he was using in a model that he was running, which included exposure to property indices of various jurisdictions all over the world. And I said, what's the problem? He said, well, the South African property index, he thinks it's in the wrong currency because the gap between the bond yields and the property yields just didn't, adhere to kind of international benchmark norms. And it was at that time, I mean, I always knew that South African property was a really spectacularly good investment in the kind of from the late 90s all the way through the property bubble in 2008 until recently. It's done phenomenally well. But only then did it really click for me that it's done phenomenally well in an uncharacteristic way. And perhaps that is the signal that there is risk in that investment. And we've seen what happened subsequent to commercial property in South Africa. I think on top of that, COVID has come in and it's completely reset the usage and the need for property. And it's reset it in a way that I don't think anybody really yet understands. I definitely am not a property expert, but what I can see is I can see a lot of to-let signs going up, and I can see a lot of businesses who are operating remotely. And when we speak to the management of those people, they are all considering plans to continue remote working to some significant extent, maybe not completely, but much more significantly than in the past. So, there are definite hard headwinds for property that might not be fully reflected yet in the price of property in South Africa. We're finding that, you can hear stories if you read the property press, but even the buoyant Cape Town market having some patches that are starting to show up soft. So I would say property at this point in time, if you're a buyer, and you've got cash and you've got time, I would be in the market and I would be, putting in low bids and seeing if people bite, because I think the market's definitely under stress and there's going to be more pressure, and we don't think, and many of our portfolio managers, I'm echoing their voices, many of them don't believe that all of the headwinds are fully reflected in the prices yet.
Thanks, Jaco. Dino, we'll be back a little later.
Absolutely. Thank you, Jaco. That was so insightful and also very interesting on that property market, which we haven't heard before. So thank you very much. So now we are going to move on to our Professor Piet, who has been in the tax game for a very, 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 very long time, meaning you're very wise and very experienced. So welcome to the show. How are you?
I'm well, thank you. And thanks for having me.
Great. So, Piet, I know that you obviously, you've been lecturing for a long time on tax. You've been teaching, you've been giving seminars for, as you've said, close on 40 years within the tax environment. And then in addition to that, you also have been involved in the legislation of actually creating some of the tax and actually lobbying for some tax reform. So I wanted to know, so I know you did have some slides. I don't know if you want to show them. I know we have talked holistically about tax-free investments, but I know there's also some basics that you wanted to cover. Do you want to share those slides? Or
yes.
Talk through them still? Yes.
Oh,
as I said, you have been lecturing for years. So I know that a lecturer can't help themselves.
Without the slides, I'm lost. So I'm a tax specialist CA, so I'm not a financial advisor. So my focus in what I want to talk about is to speak about the I hope that the slides have come through.
There they are, yeah.
Okay. So obviously the tax that you pay on the income and the capital gains that you make on your investments will drive your decision of what asset you go in. So my purpose is to just tell you what the tax implications of the different investments are. And now some of the previous speakers have done that, have done some of that. But so I'm going to run through some of it quickly, and some of it we're going to just have a little bit more of a talk on that. So with interest, with the exception of the tax-free investments that we really have spoken enough about, but I'll also just make a brief mention of that. All interest that a South African tax individual a resident here from loans, investments, anywhere in the world is actually gross income. So there's special rules for SARIA compliant financing schemes, but the principle is the same. Any interest instrument that is potentially included in your gross income, and that come from all the banks and things that we've spoken about, all the instruments that we have, and also the collective investment schemes. Now, there was a question on REITs as well. I'll briefly refer to REITs a little bit later on. So your collective investment schemes also make a distribution which consists of interest in that. Now, and what is often overlooked is that when we've got spouses that are married in community of property, where they invest individually, or they may be thinking that they're investing individually, but because of the marriage and community property, you actually jointly invest, making that investment, and your tax consequences follow from that. So it's deemed to accrue equally. So the spouse's interest added together, deemed to accrue equally to each spouse, and then you have those exemptions that Sisandile has referred to. So a person under the age of 65, 23,800 is tax free annually, and over 65 is a 34,500. Now, what's interesting is that this exemption is only available to South African source income, sourced interest. So we invest in South African banks, etc., or South African providers of the interest instrument. The moment you go abroad, there's no exemption for that foreign interest. So this, in a sense, will drive that decision. And that's where I think, and as Jaco so expertly illustrated, the tax-free investment comes to its place. Highly unlikely that one can make deductions against interest. You may have costs. So we see that. You may have portfolio management costs and earn interest. You can't deduct the interest. You're not getting on a trade. It's a passive investment. You may have, the moment you invest abroad, foreign withholding taxes. So as South Africa has, we take some tax back when we pay to a non-resident. Those foreign withholding taxes reduce the South African tax bill. So if you calculate your South African tax, the foreign withholding tax will reduce that. Now, the tax-free investment, I'm not going to say, we just repeat everything what was said previously. You can enter into a 35,000 or 500,000 overall limit. But I, as a non-financial advisor, in response to the question that somebody is absolutely starting out now, just completed, starting to work, I would say that, and for the moment, I'm ignoring Jaco's advice on this and being in the market that long. Just from a pure tax consequence, I would say that I would first make up my investment to use up my tax-free, the 23,800 and 34,500. At the interest rates that we're currently punting, you're looking at 500,000-600,000 rand in there before you meet that. And only after that, I would start in the tax-free investment. But the advantage of going into the tax-free investment is that you build up that longer period. And that's what the benefit of that is. And that is why maybe for that young person that doesn't have enough money to fill up the full 36,000 rand, doesn't have enough money to make up the cash investment that will give you 23,800 tax-free, or interest in excess of that, you would really want to split that so that you build up and get that additional benefits from that. Okay, now, and it was said earlier, there's no deduction, even though the Income Tax Act calls this an investment or a contribution, there's no deduction for this investment. So you make an investment. With regard to dividends, the dividend is taxed in the hands of the South African shareholder, South African resident shareholder, if it comes from a South African company. So I use the word dividends for the dividends declared by South African resident companies, and foreign dividends for the foreign ones, is 20%. So that's the tax. And the government is that the company paying that dividend withholds the tax. So there's nothing you can do about it. When you get it, it's after tax return, they've already deducted that. If you have a non-resident, so you may be, some of your family or friends are abroad, have still investments in South Africa, you pay the dividend to them, then they may qualify for a lower rate of tax. So the 20% does not apply to most non-residents. You must look at the double taxation treaty, and you'll find that the rate is often capped at 15%. and in many instances lower. And there are a few countries, for the life of me, I'm trying to think what the Israel one is, but just the Netherlands have got a 0% if you have a certain percentage interest in a South African company. Foreign dividends. Now, South Africa cannot have a withholding tax on the foreign dividend. I mean, we can't just control or have the foreign country and tell them to deduct money. So what happens is we receive the foreign dividends as normal gross income, and then there's a formula that the Act has, and that exempts a part of your foreign dividend. And the intention behind that is to bring the equivalent tax rate on the dividend, not to your 45% maximum, but to the 20% dividend rate. So dividend and the foreign dividends tax equally. Now, similarly, where you have a foreign withholding tax on the dividend, as is very common, that tax will reduce the dividends tax in South Africa. So the 20% equivalent on the foreign dividend may be wiped out by the withholding tax, which is often in the range of 20 or even 25, 26%. There is another exemption. If you invest in as a South African in a foreign company, and you take up more than a 10% interest, so you own, let's say, 12% interest in that company, then the dividend is tax-free. It doesn't have this complex formula of a party being exempt from tax. And the incentive of that, or the idea from National Treasury was, well, if it's tax-free, you're inclined to bring it back to South Africa. You won't leave it outside of South Africa. So, yeah, interest of more than 10%, typically these would be private companies, tax-free. And also your listed or dual listed companies, those ones are free from tax in South Africa. And as I've already alluded to, any foreign taxes withheld by the foreign country qualifies as a rebate. We've had some discussions about rental, and here I normally sit in where the advice is given to take up certain investments to just comment on the tax implications. And the client that I had was heavily involved in South African residential property, not doing really well. Admin killed her and whatnot. And I said, but why don't you go into a REIT? And we spoke to the guys, and the REIT worked out a lot better for her. She could gear the thing, and similarly being in this market there. But from a tax point of view, the rental is gross income. But now you've got to trade. You've got to pay rent on the bond. You've got to pay wear and repair of the property, etc. And you'll be able to deduct that in the net amount subject to tax. Right, now the other assets, if we talk gold and gold coins, and like diamonds, ladies, I mean, other than the sparkle that it puts in your eye, there's no income coming from these assets. And so when we invest in it, the tax consequences really are just the capital gains at the end. And I deliberately pulled up the Pyrenees and not a Picasso because of the Bloemfontein saga on this. But generally, your art can go through as a personal use asset if you reflect it and have it in your room and you watch that. So the capital gain there may be excluded on the basis that it's a personal use asset. But in most instances, the investment in these assets have no income tax consequences on an annual basis because there's no income. And the growth in value is not taxed until you dispose of it, and then there's a capital gain. So that's that. Now, this has also been alluded to, making the investment, and really one is asking the question, is there a benefit for me to make that investment? We've spoke about that in the tax-free investment space, that you don't get a deduction for that. So it would be very nice to make an investment and get a tax deduction for that. Now, there were some comments on the 12Js, the venture capital companies. I have a concern when somebody is merely investing in that company because they get the tax deduction. That's not for me proper, but I'm not a financial advisor, so I'm going to say nothing more about it. So it's only in the venture capital company space where you can make a deduction where you buy shares and for your investment. So the principal answer is when I make investments, I'm making a capital investment, there's no tax deduction for that. But when we contribute to retirement funds, and I'm using the word collectively for that as pension, provident and retirement annuity funds, then there is that, we've already referred to that 27.5% limit with an overall limit of 350,000 Rand. And yes, I personally believe that I must make use of that and get the maximum amount into my RAs. And even if I exceed that amount, you know, that it is still, it's a safer investment. The benefit of the retirement funds is that we principally, number one, we get that, and Jaco has explained it much better than I can, and so that I can also understand it now. You get this deduction of the contributions that you make. So SARS, in a sense, you reduce your tax bill by making the deduction. But then the biggest benefit in my mind, apart from the fact that it's outside of your estate, is that the growth inside the fund on capital and income, etc., is completely free from tax. Apologies, I made a spelling mistake there. So this is the beauty of that product. So when I invest directly in the same shares or same investments that sits in the retirement portfolio, I would pay tax on their incomes. Dividends would be subject to the 20% tax. When they accrue to the retirement fund, there's no tax, and we can get that bigger growth. The tax consequences only arises when the member retires. In tax talk, we talk about when you elect to retire, normally when you reach retirement, normal retirement age. And it's very flexible. And this has started in 2009, where the National Treasury said we must force people, or not force, we must allow people to remain in this regulated, protected investment environment that has all these tax benefits for as long as possible. So you can plan your exit from the fund. But when you exit, you've got the taxes. And the taxes essentially is that when you leave at a normal retirement, and this is a cumulative amount, so if you haven't taken any previous withdrawals from the fund, the first 500,000 is taxed at the rate of 0%. If you exit the fund, maybe when you leave an employer and you want to take a cash withdrawal from the fund, then the first 25,000 rand subject to 25%. The rate then is 18%, a maximum rate of 36%. We've had some reference to that. For people wanting to leave South Africa, the law is changing. From the 1st of March, if you exit South Africa and you want to access your retirement funds, your retirement interests, and you can only do that in 3 funds. It's the retirement annuity fund and your pension preservation fund, or your provident preservation fund. Then you will have to wait 3 years before you can access your retirement interest. So this is a negative where you intend to leave the country. And then one would say, but hang on, I'm not going to invest in that because then it's locked in here for 3 years after I've left. If you leave now and you formally apply to the Reserve Bank before the end of the month, you've got 2 weeks left to do that, and they approve that by the end of Feb 2022, you can still take the full interest amount. But yeah, so the negative of that, retirement interest, the benefit, whatever grows in there, the income not taxed in your hands. When you exit, there's a tax on that, and you can then only take 1/3 in cash, and the balance will buy the annuity, which is then taxed as a pension. Capital gain. So whenever we dispose of our assets, you want to move into another one, other than your retirement interest, which I've explained now, you will have a capital gain. And that's basically the difference between what you've paid to acquire the asset and what you receive when you now dispose of it. When you invest in an asset and you acquire it in a foreign currency, as a natural person, the fluctuations of the rand let's just call it the exchange differences that arises on that, is ignored. So you can have a person, to just give an example, that invests 1,000 rand in a South African asset and 20 years later sell it for 3,000 rand. The capital gain is the 2,000 rand, the difference between the two. If I invest and I take out 100, or let's stick to the same numbers, $1,000 investment, 20 years later, I sell it and it's worth 50,000 rand, but it's only grown to, let's say, $3,000. Then the capital gain is only the $2,000 converted to rands, which is significantly lower than what the actual value is that you've received. So, but there's a capital gain. Now, we effectively have a 40,000 capital gain annually that we can make that will not be taxed. And then the capital gain is not taxed in full. So the difference between all other returns on our investment products And the capital gain is that only 40% of the capital gain is included for the natural person, and the balance is then not subject to tax. One of the big problems, and this is, we've seen that with the delistings of some of the assets, of some of the shares on the stock exchange, where you're forced to exit one category of assets and move into one, other than in the wrapper, as Jaco's explained, where you can move around in the within the wrapper and you don't have the disposals. But if you have to, you've invested in a share, and after a number of years you say, okay, there's a risk, I'm no longer want to be staying in it, and I'm moving it to another one. Then you realize a capital gain and you tax on that capital gain, and the fact that you're reinvesting it in another share is not giving you a rollover of the capital gain. So the capital gains is that every time there is a disposal of the asset. But that's what makes the collective investment scheme or the wrappers then so useful, because there the capital transactions happen in there, and you will only have tax consequences when you exit as a unit holder from that collective investment scheme. So there is a possibility to roll it over. And then, of course, we've spoken about it. You've got a life expectancy. When you die or you donate the assets, there will be capital gains, there will be estate duty, and there will be donations tax. But on death, whatever the capital gain turns into in normal tax, that tax will rank as a tax deduction. Now, just the last thing that I want to deal with, and I hope that I'm not taking too long. I think I'm still there. Yeah. What one really wants to answer here is, must the investment be in my name? So for estate duty purposes, we often want to put money in a trust, so to keep it outside of so that the growth happen outside of our own estate, and we reduce estate duty. So my typical structure that I propose for housing your investments is, yes, I would have the trust, but I would like the trust to hold a company, and the company would make investments in other companies, for the reason that dividends between companies are tax-free. You've asked about a tax-free investment. The law is clear. It's only available to natural persons. So Jaco had it right there. But if I invest directly into shares, then the 20% tax is levied on that dividend. But when I have that investment in a company, the company receives a dividend, the 20% tax does not apply. I've got more money to reinvest. So that's basically the reason why I would go for that. The problem is getting the assets into the trust. We'll have a capital gain account, we'll have the capital gain. It will have all sorts of other implications if you don't charge interest, which is common. When you start your trust up, the trust may not have money, well, definitely will not have money, will not be able to get money. So you will have some implications for that. Okay, let me unshare my screen. That was, as we say, that was primary school tax. So just a basic explanation of the tax consequences and the tax that drives your, when you look at that and you say, but okay, I want to maximize my after-tax return on my investment. So you need to know what the taxes are. Anna, thanks.
Thank you. I think you gave us a great insight just on, again, the basics. So we've got the big picture. I think we also went backwards and forwards in terms of looking at the global economic picture, at all the different options in terms of asset classes, in terms of tax free savings. We're going to just play an ad here from Wits, as you are a professor at Wits, and we know it still is a world-class institution. So thank you so much. And we know that all your students clearly get the benefit of your years of experience. So I'm sure being their lecturer must be very, very insightful. And in fact, they're very lucky to have you.
I hope so. But thank you.
So thank you. So we do have questions for you, but I actually want to bring back our entire panel so that we can just do a quick closing and bring everyone up, so that everyone can turn on their cameras. But
so Dino, while people turn on their cameras, can we ask them each to look? Piet, I have a question for you that's come in via my cell phone, okay. But can I ask everyone else to look into the Q&A and just select one question that you would like to answer? But Piet, the question that's come in for you, and I'm to and froing with the person asking the question, and they say, if they're an investor in shares, and they make a capital loss in year one, can they set off that capital loss in year 2? And how long is that capital loss retained for to set off against capital gains over the following years?
Yeah, that's a very good question. And it's different for a company, and that's why I would, when I have shares investments, I would take it to the company apart from the capital gain inclusion there. So let's take an individual investing in a portfolio and making a loss, selling out, exiting. So let's say you had a couple of Sasol shares or Steinhoffs, and I mean, they didn't perform as you wanted to, and you exit from that. The problem, the capital loss can be carried forward, but in the year that it arises, it's reduced by the 40,000 Rand. So the principle here is that because we don't tax a capital gain in excess of 40, well, we don't tax a capital gain if it's less than 40,000 Rand, the capital loss is also lost to the extent that it's less than 40,000 Rand. So the amount for the natural person then exceeds the 40,000 Rand can be carried forward indefinitely. I've seen transactions where a person had suffered a capital loss in 2003 and now only now have made it was a farm sale, and now they've sold another farm and made a capital gain, and that loss was available. So it's carried forward and it's not annually reduced by the 40,000 Rand, but only in the year of disposal. So it's there forever. And I think the more common question we have is, I bought shares in South Africa. I made a gain on that. I bought shares abroad and I've made a loss on that, or vice versa. Those losses and gains can be set off against each other. So in the capital gain space, the losses are available to reduce other capital gains, but it will not reduce your other income.
And an ancillary question to the one that came in is, when is one deemed to be a share trader and pay full tax on the profits you make in shares as opposed to capital gains tax on their sale?
Yeah, so let's make that practical. So let's say in March last year, I bought Sasol shares at 27 Rand, and I said, look, I just couldn't afford to buy them previously, so I have this intent that I will hold them now forever. But 2 months later, it's sitting at 68 Rand and I sell them. Will SARS treat that as a capital gain, or will they treat that as a speculative interest? And time does not, and I'll give that because there's a 3-year rule. So when we determine something like that, particularly where it happens within the 3-year period, we look at the intention of the taxpayer. So when we look at income, and this is, and I'll keep it very brief, when tax was introduced in South Africa in 1914, and then in the 1962 Act that we currently have, the heading of the Act is that we want to tax income. They never defined income, but they said something that is capital in nature is not income. So it went to the courts, and the court said, okay, what is then capital in nature? And the court says something will be capital in nature if it's not derived from a business, to simplify the matter. So a once-off transaction like the Sasol one, where I've entered into the transaction, I had a long-term intention, and in particular, I gave an opinion on this one. The person then, due to COVID-19, lost his job, lost his business, and said, now I need money. That was the reason for the selling of the share. This will never be income in nature. It will be capital in nature. So, but you have this onus of proof. You have this, SARS is going to doubt you. And so, look, you speculatively entered, and I think it's relevant to the Bitcoin stuff. And for that reason, they brought in a 3-year rule. So we have this automatic, if I held a share, even if I had speculatively acquired that share, and I hold it for 3 years, after the 3-year uninterrupted period, it will be capital in nature. So there the period comes in. But generally, a longer period of holding is indicative of a capital nature, where, if you want to speculate, you buy and sell within a couple of, it's trading stock. It's meant to be turned around. And that has that impression of I'm carrying on a business, and for that reason, that must be my normal income.
Cool. So, Dina, shall we ask our panelists if they've selected a question they'd like to answer? off. I think we've got 22 unanswered questions in our Q&A section. Kyle looks like he's falling asleep there. My sense is he's probably getting up at 5 o'clock to go cycle through the mountains. Kyle, do you want to answer a question first of your choosing?
Sure, thanks. Certainly not falling asleep. I find tax very, very, very interesting and and confusing. There's a question from Kathy on, does Signia offer a wrapper option? And the answer is yes. So you can go direct into any of our unit trusts, or for no additional cost, you can get that wrapped in either a tax-free savings account or retirement annuity, a living annuity, or straight into a policy, an endowment, IPF endowment, depending on your choosing. And obviously, depending on which wrapper you want, depends on your tax situation and your time horizon. But yeah, they're all there, they're all available, and they're all free.
Fantastic, thank you. So, Jarrod, have you selected a question from
Jarrod's got nowhere to go because they're on lockdown in the UK. He can't even leave his loft.
I got to go eat dinner just now. Yeah, to be honest, I mean, the questions here seem to be very South African centric, but there's one that I'll answer. It's about where should I invest my money for a 12 or 13-year-old? And I think the answer is you need to invest in growth assets. So definitely the equity markets, and depending on the quantum involved, I would probably go and look for some kind of ETF, something, you know, like a NASDAQ or an S&P 500, and just put it all in there.
And leave it there. As we said, we've seen the power of the long-term investment strategy. So absolutely. All right, thank you. And then Jaco, have you got a question that you've selected?
Yes, a gentleman by the name of Johan Kruger submitted quite an interesting question. So it refers to the debate about, you know, if you're young and you're starting out in life, how do you prioritize where you allocate your excess money? You know, do you pay off your bond first? Do you put some in your retirement annuity and only what's left you use to accelerate your bond payments? He had a really interesting question because he said, Jaco, surely you've just made the case that paying off your mortgage bond is better before you put money into a retirement fund, because prime at 7 means pre-tax, the cost is at least 2.5% more. So he's trying to use the formula that I used for the value of the tax savings in the retirement fund. Now he's close to the right answer, but the long-term expected return you can earn on your retirement fund, especially because it's tax-free, is in the region of inflation plus 5 to inflation plus 6. That's been what South African retirement fund portfolios have delivered for 50 years. If you look back over the long history of our retirement industry in South Africa, and you can have your views about where we are in SA at the moment, but if you say you kind of have a rate where inflation is at the moment around about 3-4%, and maybe that goes to 5, it means your equity or your portfolio performance will be 10 or 11%, which is just a little bit more than that break even 2.5%. You know, so I'd say the formula still holds. The retirement fund, to my mind, still pips paying off the mortgage bond, and I think it's a discipline thing as well. The worry I have about people, and this is where behavioral science sometimes come in. You know, personal finance isn't just all math. Personal finance is 50% psychology, and I think what you need to factor into the equation is that once people don't allocate money to their retirement fund, they get it in their bank account with their monthly salary. And it takes an extremely disciplined person to take that money and then go and put it in their mortgage bond and not take it out again. So I think, you know, even if the math is 50-50, I would say the behavioral finance pips me towards saying, you know, it's better if you never even see that money, because then you're not working it into your budget.
Absolutely. I mean, we haven't even discussed behavioral finance, which is a whole other component, I think, of all of this investment strategy and the actual science and the actual learnings behind it. But that's a whole nother webinar, I think, all on its own. And I don't know, Piet, if there was some other question that you wanted to answer as the last input on your tax. I mean, also the world of tax and immigration, and there's a financial immigration. I mean, that again is also just a mammoth field.
Yeah, I think so. Yeah, there's this question. Let me just read it. Yeah, an anonymous attendee, so an AA. If the trust holds a company to avoid paying tax on dividends, surely the company will have to pay company tax on the profits. And because this is a structure that I'm suggesting, that's why I want to answer that. So yes, so if we look at my proposal, I have a trust that owns all the shares in the company, and the company then invests in another company. That dividend that the company receives that's being held by the trust is now tax-free. There's no dividends tax on that, and there's also no income tax on that. If that dividend is immediately undistributed as a dividend to the trust, then the 20% tax will kick in. And that's what I'm saying is you will reinvest that dividend because you now have more money available to reinvest. If the company carries on normal business activities, then it will pay tax at 28%. And unfortunately, if it makes a capital gain, it will not have the 40% inclusion, but the 80% inclusion and the 20%, so negative on the capital gain there. But yeah, so it still is on your trading activities in the company, you'll only pay 28%. So if you have so to give an example, I have a super specialist medical practitioner making a lot of money. We incorporate them. The trust can't hold the shares there, but just to illustrate that, if that income accrued to him, he would pay tax at 45%. Now we take sufficient income to meet his living expenses, which is significant, but we leave the balance in the company, and that is being taxed at 28%. And he has that money available to now invest that money. Come to retirement age, you convert the company into a private company, put the shares in the trust, and go on with that. So that's the principle in there. Yeah, only when it moves out that you have the 20% dividends tax that kick in there.
Great. And I know the tax laws keep evolving in this country, and the sections, wonderful things, and offshore trusts and how to structure as well. Again, so
we'll hear on Wednesday what evolvements they are, so that they are looking for new ways to taxes, and they're going to probably bring in some new things that they want to tax. So yeah, it will evolve definitely in next week.
Right, so I mean, listen, I think we have done a mammoth job this evening. I think from Kyle to Jarrod to Jaco to the professor, I think we have literally covered like a massive, massive spectrum of investments with all the implications on tax, on the markets, on emerging. So I think all of you have been incredible. Howie, I don't know if you do want to ask another question, but I just think that all of you are just absolutely, I mean, the comments are coming in that they are so impressed with the level of our panelists and our speakers and the input and the way you put it all across. So thank you all very much. You have been absolutely invaluable to our panel this evening.
Dina, I think the key thing is we're heading for the end of the tax year in just over a week's time. So people have a lot of decisions that they need to make over the next week and a half or so in order to make sure that they minimize the amount of tax that they have to pay through to the receiver. Not because we don't think it's appropriate to pay tax. We absolutely do. We have to fund a country. We have to fund COVID vaccines. We have to do all sorts of things. But we also don't believe we should pay more than is absolutely necessary for this. And that's probably what the most loyal thing you can ever say as a South African. Let's pay our fair due, but let's make sure we don't pay more than is absolutely required. So with that, I'd love to thank all our panelists this evening. It's been the most remarkably informative evening. You can see from just the polls that we've taken the level of interest that people have in all of the products that we've spoken about tonight. We'll be back on Saturday night with, don't forget, our Unplugged evening. So it is old traditional bar songs, and we want you to kick back, throw off your slippers, have a brandy, a whiskey, a glass of wine, and sing along as we sing Billy Joel and Elton John and Don McLean and Streets of London and Piano Man. So that's going to be on Saturday evening. On Sunday evening, we're delving into the minds of the matric class in 2020, and we're going to understand their views on things like money and Bitcoin and their future and where they think they'll be living in 5 and 10 years' time, and their views on things like God and brands and loyalty. That's all part of the mind of the matric class of 2020 at 7 p.m. on Sunday evening. And next Saturday night, we have our amazing Purim play called Purrington. And we'll see you again on Saturday evening. Thank you all for joining us this evening. If you'd like to leave a comment, we'll leave the comment section open for the next 5 minutes or so. Dina, thank you for running tonight's panel. It was really so informative. Danny, thank you for everything that you do on the controls. Much appreciated. We'll see you on Saturday evening. Good night, all.
Thank you, everyone. Have a good night.